The topic which we are about to discuss right now is what? Gratuity. Gratuity is another component under the head salary. Let's understand what are the things that we have to learn under this particular component. So, tell me friends, what do you mean by gratuity? What do you mean by gratuity? So, what is gratuity? It's actually a payment given by the employer to the employee for the services done by the employee during this period of service. Yes or no? It's actually gratuitous payment. What do you mean by gratuitous payment? Employee is not required to give anything to the employer. Okay. So normally for pension and provident fund, the employee is supposed to give a portion of his salary to the respective account, but not in the case of gratuity. Gratuity is completely gratuitous. The employee is not supposed to pay any penny to the employer. It will be completely on the employer. Are you with me? Again, another retirement benefit. Hope you remember yesterday or last session we have discussed about what is gratuity, what is pension, and what is provident fund. Now, gratuity means what? There is a definition. Means a voluntary payment made gratuitously by the employer in the appreciation of services rendered by the employee. So it is actually a voluntary payment, that is a gratuitous payment made by the employer to the employee, just like a thanksgiving or just to show his appreciation that you have worked along with me for a longer period. So now you are retiring, as a compliment or as as thanksgiving or to show gratitude. I'll give you a lump sum amount. This is the concept of what? Gratuity. Now you tell me, gratuity received by an employee is on account of what? Gratuity received by an employee is on account of employer-employee relationship. Are you with me? And hence it has to be considered as a component of salary and you have to tax it accordingly. So what department say is, if you are an employee who is in receipt of gratuity at the time of retirement or at the time of your death, then you are eligible to claim an exemption which is under section 10, subsection 10. Are you with me? If you are an employee and you are receiving what? Gratuity, either on account of your retirement or on account of death. So maybe on death, your legal hire will get what? Gratuity on your behalf. Are you with me? So whatever gratuity received by a person on account of retirement or death, he can claim an exemption. That's what we are about to learn. Before that, one more thing. If you are withdrawing your gratuity during your period of service, that withdrawn gratuity shall be fully taxable. An employee can withdraw his gratuity during his period of service itself. That is also fine. Are you with me? So if you are withdrawing the gratuity during the period of service, then that amount shall be fully taxable. You are not eligible to get any exemption. If you want to claim exemption, you have to withdraw the gratuity either at the time of retirement or on account of death. Are you all here? So gratuity received at the time of retirement or death. We can divide that exemptions into two categories. Okay, number one, if it is under pension code or regulations applicable to the member of defense service, employees of central government, local authority, or employees of civil services, it shall be fully exempted. Something similar in the case of pension also. Commuted pension in the hands of government employees, defense services, etc. were fully exempted. Likewise, death or retirement gratuity withdrawn by either the members of civil services or defense services or local authority or central government employee, or you're withdrawing any gratuity under any pension code or regulations, any other pension code or regulations, then again we can say that entire amount of gratuity that you have withdrawn shall be fully exempted. Are you with me? Are you with me? Now you tell me, if I am a private company employee or I am a other employee, I am not a government employee, I am coming under other category, how do we claim exemption? For other employees, we have to split that exemption into two. There are two set of exemption. Are you all listening? The first thing that you have to check is whether you are covered by Payment of Gratuities Act 1972. There is an act called Payment of Gratuities Act 1972. If you are getting a gratuity under the respective act. Which act? Payment of Gratuities Act 1972. First of all, you should understand, for certain class of employees, gratuity payment is mandatory. It is covered under Payment of Gratuities Act 1972. Depends upon the industry that I am into. Now, say for example, I am an entity, I have only 5-6 employees, but I can give voluntarily gratuity. What is voluntary gratuity? It is not mandated by any act, but I can give gratuity to my employees. In that case, it will be not covered under Payment of Gratuity Act. If an employee is covered under Payment of Gratuity Act 1972, your exemption will be computed as this. If the employee is not covered under Payment of Gratuity Act, your exemption will be as this. So there are two set of exemptions. Are you with me? Are you all listening? Perfect. So let's understand for other employees, what is the first criteria that we are about to discuss? If you are covered under which act? Payment of Gratuities Act 1972. Then how to claim the exemption? The department say the exemption shall be least of the following. The least of the following shall be your exemption. And now let's understand how to compute the exemption. There are 3 limits provided in the act. Least of the following shall be your exemption. And you tell me what is limit number 1? Rupees 20 lakh. Limit number 1, they are giving a statutory limit as rupees 20 lakh. What is limit number 2? Gratuity actually received. What is that? The actual amount of gratuity that you have received is said to be limit number 2. And what is limit number 3? This is what you should learn. What is limit number 3? Department say 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. They are giving a statutory limit, a statutory equation. What is the equation? 15 divided by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. What do you mean by completed year of service or part thereof in excess of 6 months? Say for example, you are retiring after 10 years of service. 10 years and 8 months. You are retiring after 10 years and 8 months. You have to consider it as 11 years. Why 11 years? Because there is a part thereof in excess of 6 months. If there is a part thereof in excess of 6 months, you have to round it forward. Just like our normal rounding off, you have to round it forward. So it will be considered as how many years? 11 years. What about say 10 years and 3 months of service? What to do? You should consider it as only 10 years. Are you with me? So if the department says that you have some period of experience or some months of experience which is more than 6 months, then you have to round it forward or otherwise backwards. Are you all with me? Are you all with me? Very simple point, friends. So what is the last limit? 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. What is this 15 by 26? 26 means 26 working days. You take 15 days pay out of 26 working days, that into your last drawn salary. What is this last drawn salary? The salary that you have withdrawn just before your retirement or death. That is said to be what? Last drawn salary. And there's the definition for the word salary. What's the definition? It simply says basic plus DA. What is DA? DNS. Here they are not saying it should form part of the retirement benefit or something. Simply they are saying DA. That means if there is DA, whether that DA forms part of the retirement benefit or forms part of the employment or not, doesn't matter. That DA have to be considered. Are you with me? Are you with me? Have you understood the concept? So the point is very simple. Salary here means what? Basic salary plus DNS allowance, whether it forms part of the retirement benefit or not. Are you all here? Perfect. Now, so let's see that particular limit again. So friends, listen. If you are an employee, that means a private company employees, and you are covered under Payment of Gratuity Act, you tell me, how do you claim exemption for gratuity that you have withdrawn at the time of retirement or death? There are 3 limits. Limit number 1, statutory limit rupees 20 lakhs. Limit number 2, actual gratuity received. Limit number 3, 15 by 26 into last drawn salary into completed year of service or part thereof in excess of 6 months. You take these three, pick the lower one. That lower amount will be your exemption for gratuity. The rest of the gratuity, if there is any, shall be fully taxable. Which is the section? Section 10. Section 10, subsection 10. Are you with me? The section is section 10, subsection 10. Section 10 provides for exemption. So this exemption is as per section 10, subsection 10. Are you all listening? Yes. Perfect. Okay, friends, so let's move on. This is how you have to compute the. Now, friends, listen. If you are an employee and you are not covered under Payment of Gratuities Act. What do you mean by not covered under Payment of Gratuities Act? You are not covered under Payment of Gratuities Act, but your employer is voluntarily giving you gratuity. You are more happy because the employer shows a lot of respect to the employee. That's why he is voluntarily giving a gratuity. In that case, how do you claim exemption? Again, department say exemption shall be least to the following. Which all are the limits? Number 1, rupees 20 lakhs. Statutory limit rupees 20 lakhs. What is limit number 2? Actual gratuity received. What is limit number 3? 1/2. That is half into based on average of last 10 months salary. What do you mean by average of last 10 months salary? You add last 10 months salary and divide it by 10. That's how you average it. Average of 10 months means you add 10 months salary, then divide it by 10. You will get the 10 months average salary. Then into completed year of service. Here there is a speciality. They are not saying part thereof in excess of 6 months. So what to do? Here in the other box they were saying or part thereof in excess of 6 months. But here they are not saying part thereof in excess of 6 months. So you tell me what to do in such a scenario. Very simple. Say you have 10 years and 9 months service. You have 10 years and 9 months service. Then how to consider? Only 10 years. You ignore the months. If they are saying nothing, then completed year means completed year. You have to ignore the months. If they are saying part thereof in excess of 6, then you have to round it off. If the balance month is 6 months or more. Are you with me? Are you with me? Have you understood the concept? So it's very simple. What is the last limit? 1/2 into based on average of last 10 months salary into completed year of service. They are not saying part thereof in excess of 6 months. Now there is a definition for the word salary here. Can you read the definition? Salary equal to basic salary plus DA, DNS allowance, if forms part of retirement benefit plus commission, which is expressed as a fixed percentage of your turnover. This is named as standard salary. Do you remember? We have put a name for this definition that is called as what, friends? Standard salary. And what was the definition? Basic salary plus DNS allowance, which forms part of a retirement benefit, plus commission only if it is expressed as a fixed percentage of the total turnover of your employer. Then you can consider that as well as a part of standard salary. Now there is one more thing. There is something in bracket. What is that? Based on last 10 months average salary immediately preceding the month of retirement. What does that mean? Say for example, say I'm retiring on December. You should consider the standard salary from November up to past 10 months. Then you should average it. You are not supposed to take the salary of December. When you average it, you exclude the retiring month. Take the average of the last 10 months, excluding the retiring month or preceding the retiring month. That's what the department says. Are you with me? Are you with me? So what they are saying, again read that. Based on what? Based on last 10 months average salary immediately preceding the month of retirement. Are you all with me? Are you all with me? So we were discussing about what? The exemption under section 10, subsection 10. Now let's revise that entire exemption one by one. So friends, this was all about the gratuity. If you are an employee who receives gratuity at the time of retirement or death. You are eligible for exemption according to section 10 subsection 10. That's what we have learned. Are you with me?
Yes,
Now, whatever gratuity that you receive on account of retirement of death is only subject to exemption. If you are withdrawing your gratuity liability during your period of service, that entire gratuity shall be fully taxable. Now, to claim the exemption, we can divide that into two. All the gratuity which is withdrawn under any pension code or any regulations applicable to the members of defense services, employees of central government, local authority, or employees of civil services, fully exempted. Don't need to do any math and all. It is fully blindly exempted. Are you with me?
yes, sir.
Second one, in the case of other employees, in the case of what? Other employees, how do you claim exemption? Very simple. In the case of other employees, you should divide or you should separate that into two. Which all are the two splits? Number one, covered under payment of gratuities act. Number two, not covered under payment of gratuities act. If the employee is covered under payment of gratuities act, then there are three limits. Which all are the limits? Either rupees 20 lakh or actual gratuity received or 15 by 26 into last drawn salary into completed years of service or part thereof in excess of 6 months. Their salary means simply basic salary plus DNS allowance. Don't need to add anything else. Now, number two, what is the next one? If you are not covered under payment of gratuities act, then again rupees 20 lakh or actual gratuity receipt or 1 by 2 into last 10 months average standard salary. But while considering standard salary, you should exclude the retiring month into complete year of service and ignore fraction of months and pick the lower, and that lower will be your exemption. It is as simple as that. Are you all with me? Have you understood the concept? Perfect. Now, moving on, there are a few notes in relation to this. There are certain other points that you should consider while going through this particular exemption. Let's read other points one by one. So, what is first other point? Where gratuity is received from two or more employers in the same year, then aggregate amount of gratuity exempt from the tax cannot exceed rupees 20 lakh. What does that mean? Say, for example, say in the year 2024-25, in the previous year 2024-25, say on July 31st, on 31st July, I've retired from, I was working with two employers. So we can say I'm a part-time employee. Morning shift I'm working with employer 1, evening shift I'm working with employer 2. Are you all here? Are you all here? Or are you dreaming about something else? Only dream about what? Income Tax Act. Okay, only dream about Income Tax Act. Nothing else should come in your dreams. Yes. So coming back to the point, you're retiring on 31st July from employer 1 and you receive the gratuity of say rupees 10 lakh or I'll say 12 lakh. Your actual gratuity received was how much? 12 lakh. We put it under that limit, either 20 lakh or actual gratuity received or say 15 by 26 into last round salary into complete year of service, and the lowest was 12 lakh. Are you with me? So we took that entire 12 lakh rupees as exemption. Are you all with me? Again on say February 2025, I retired from employer 2. Now the question is, can I claim exemption again? Because I've already taken an exemption in that year. My question is, can I claim exemption again when I'm retiring from employer 2 and receiving gratuity? The answer is yes. I can again claim exemption, but there is a condition. What is the condition? In our exemption, the first limit is a statutory limit of 20 lakh. Yes or no? And I have already claimed an exemption up to 12 lakh. Now from the statutory limit of 20 lakh, I have to deduct 12 lakh and I can claim only 8 lakh. So my statutory figure will become how much? 8 lakh. That simply means in a person's lifetime, he can claim maximum only up to 20 lakh as exemption. Are you with me? In a person's life, a person can claim maximum of rupees 20 lakh as an exemption. Not more than that. So First instance, I've already claimed 12. So when I'm retiring again, my statutory limit have to be the remaining 8. Have you understood? Have you understood the concept? Even if I'm retiring in the same year or different year, the equation is the same. I have to reduce that exemption claimed earlier from the statutory limit of 20 lakh. Whether I'm retiring in the same year or another year, that doesn't make any difference. I have to deduct the first exemption figure from the statutory limit of 20 lakh. That is what is the second box is about. Where gratuity is received in earlier year from former employer and again received from another employer in a later year, then the limit of 20 lakh will be reduced by the amount of gratuity exempted earlier. So the concept is same. In a person, in his lifetime, maximum exemption that he can claim under section 1010 is up to 20 lakhs, not more than that. Are you with me? Perfect. Now, what is the last point? The exemption in respect of gratuity would be available even if the gratuity is received by widow or children or dependents of a deceased employee. Obviously, because in case of death, the employee will not be in a position to accept the gratuity. Why? Because he's already dead. Yes or no? So the gratuity will be paid to his children or family members or dependents. Then in that case also, they can also claim exemption under section 10, subsection 10. Are you with me? Perfect. Now there is one more note. What is that note? Can you read that note? Gratuity received during period of service is fully taxable. If you are in receipt of a gratuity during your period of service, it shall be fully taxable. There is no exemption at all. Are you all with me? Have you understood the concept? So the exemption for gratuity depends depending upon one factor, whether you are receiving gratuity at the time of retirement or death. If yes, eligible for exemption under 10, subsection 10. If no, no exemption. Fully taxable. Under the head, salaries. I hope the concept is clear. We are about to discuss a concept called as what? Annuity. So tell me, what do you mean by annuity? Any idea? What do you mean by annuity? On account of employer-employee relationship, if the employer gives any annual benefit to the employee, that is commonly called as what? Annuity. It simply means annual sum given by the employer to the employee. So let's understand the treatment if the employer gives any annuity to the employee. So annuity means yearly sum or a grant received by a person. Annuity received from the present employer. What do you mean by that? You are working with a company and you are still working with a company. During your period of service, your employer has given you an annuity. You tell me what will happen. Taxable as salary under this head. Which head? Salary head. If the employer gives any annual sum to the employee, that entire annual sum shall be fully taxable under the head salary. There is no exemption at all. Are you with me? Point number 2. Annuity received from past employer. What do you mean by past employer? You retired from an employer. Okay. Now you received an annuity from your past employer. You tell me, what is the treatment? Taxable as profit in lieu of salary. What do you mean by profit in lieu of salary? What do you mean by profit in lieu of salary? A receipt which is similar to salary. That is called as what? Profit in lieu of salary. Are you with me? What is profit in lieu of salary, friends? A receipt which is similar to salary. It simply means a receipt similar to salary. That's it. There is nothing. Salary only. Okay. It has some receipt which is similar to salary is normally called as what? Profit in lieu of salary. Now, what if the annuity received from any other person taxable under IFOS? What is the full form of IFOS? Income from other source. So there is no exemption and nothing it is. If the annuity is received from past employer or present employer, it will be taxable under the head salary. If a person receiving annuity from someone else, will be taxable under IFOS. Are you with me? Because only those sums which have an employer-employee relationship will be assessed under the head salary. saying if you are receiving any annuity on account of past or present employer-employee relationship, then it will be taxable under salary. Otherwise, under IFOS. Is that clear? Is that clear? Perfect. So that's how it is. There is nothing, there is no exemption and nothing to study under that particular component area. Now, we have completed gratuity and annuity. Now we will move on to another important component of salary that is called as what? Treatment of leave salary or leave encashment, which is under section 1010AA. So let's understand what exactly is the treatment of leave salary or leave encashment. So friends, tell me, what do you mean by leave salary? Any idea? What do you mean by leave salary? Say for example, leave salary simply means, say in a company, imagine I have 30 days leave in a year. I have how much? 30 days leave in a year. That means approximately 1 month I can take as leave. But in that year, I haven't taken any leave. In that year, I haven't taken any leave. That means what? I've worked for an extra 1 month. I would have taken 30 days leave because in my company, according to the company policy, every employee can take 30 days as leave. But due to my commitment, I haven't taken any of those leaves. Then what will be the impact? I could have taken 30 days leave, but I haven't taken any leave. So I should get 30 days extra salary. Yes or no? So that what the employer will do is, the employer will encash that leave credit. The employer will what? Encash that leave credit. Give salary for that leave that he haven't taken. It is called as what? Leave salary or leave encashment. Are you with me? Are you with me? So if the employer is providing, so the employee is not taking the allowable leave in an entity and he is asking for an extra salary, then that extra salary for his leave credit is said to be what? Leave salary or leave encashment. Are you with me? Perfect. Now let's move on to the definition. Leave encashment means unavailed leave credit encashed by the employee. It is not employer, it should be employee. Are you with me? Oh, that means encashed by the employee. Employee is the one who is encashing it. Are you with me? Employer is the one who provides it. Are you all here? So, means unavailed leave credit encashed by the employee is said to be what? Leave salary. Are you with me? Now, one thing is there. In most of the companies, they will give this leave salary yearly. What do you mean by leave salary yearly? In the year end, they will check the leave status and they will encash it. If you are receiving it yearly, then that shall be fully taxable under the head salary. There is no scope of any exemption at all. That's what is written here. Received during the period of service shall be fully taxable. But if an employee is accumulating his leave credit and encashes it in a go at the time of his retirement or death, then he is eligible for an exemption. Rather than encashing it yearly, if he accumulates everything and it encashes in a go at the time of his retirement or death, then he is eligible to claim an exemption, which is under section 10 subsection 10 AA or AA. Are you with me? That is what we are about to discuss right now. Are you all listening? So let's see. So received during the period of service shall be fully taxable. How about received on retirement or whether on superannuation or otherwise? What is superannuation or otherwise? You're resigning it. Either you're retiring or you're resigning from a company and you're encashing your entire leave credit balance in a go. Then you are eligible for an exemption, which is as per section 10 subsection 10 AA. Are you all listening? Let's understand how do we claim that particular exemption. So listen, what is leave encashment? The leave credit encashed by the employee is said to be leave encashment. Leave encashment, that payment under leave encashment received during the period of service is fully taxable. If you are encashing it at the time of retirement or resignation or superannuation, etc., then you are eligible to claim an exemption under section 10 subsection 10 AA or double A. So let's see how do you claim this exemption. As usual, if it is withdrawn by government employee, that means state government or central government employee, then it is fully exempted. If you are a state government or a central government employee withdrawing this leave encashment, then the entire amount that you have withdrawn shall be fully exempted. You need not pay any penny as income tax for your leave encashment. It is fully exempted. Are you with me? Are you with me? Perfect. How about the other employees? Other employee means you are not a government employee, you are other sector employee and you are withdrawing the leave encashment. Then how do you claim exemption? The department say least of the following shall be exempted. There are 4 limits mainly. Least of the following 4 limits shall be your exemption if you are withdrawing the amount as leave encashment in other case. Now, which all are the 4 limits? Number 1, rupees 25,000. 25,000 rupees, sorry, 25 lakhs is the limit number 1. Are you with me? It's a statutory limit, and how much is the limit? 25 lakhs. And what is the second one? Leave salary actually received. What do you mean by leave salary actually received? What do you mean by leave salary actually received? The actual amount that you got at the time of encashing the leave credit is said to be what? Leave salary actually received. Are you with me? How about the third limit? Can you read the third limit? 10 months salary on the basis of average salary of last 10 months preceding retirement. What does that mean? Can you read that box again? 10 months salary on the basis of average salary of last 10 months preceding retirement. It simply means what? You take the total last 10 months salary. Are you with me? That's it. That's it. They're simply saying you take the total last 10 months salary. What do you mean by salary here? Salary equal to basic salary plus, read, basic salary plus DNS allowance, each form part of retirement benefit plus commission, which is expressed as fixed percentage of total turnover of the employer. It also called as standard salary. Are you with me? Basic salary plus DA forms part of retirement benefit plus commission if it is expressed as fixed percentage of your turnover. It is also called as what, friends? Standard salary. Are you with me? So what is limit number 3 again? Last 10 months standard salary. That's it. You take the last 10 months standard salary, you will get the limit number 3. What is limit number 4? Limit number 4 is the tough one out of this 4. What is that? Cash equivalent of. I want all of you to read limit number 4. Otherwise, you will never understand that. Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. Okay, stop. Read that again. Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. That simply means you take how many days of leave he has. You take how many days of leave he has or how many months of leave he has. Then you encash it based on the last 10 months average salary. Are you with me? And there is one note under that. What is that note? Earned leave entitlement cannot exceed 30 days for every year of actual service. What does this mean? I'll give you an example for a better understanding of that limit alone. Okay, imagine I'm working in a company. Say I'm working in a company and my company policy is say 40 days leave for every completed years of service. We call it as eligible leave. If I complete 1 year, I will get 40 days leave credit. Are you with me? I worked in that company for say 20 years. I worked in that respective company for how many years? 20 years. I took say 100 days leave. during my entire 20 years, I only took how many days? 100 days leave. Are you with me? The employer have done some kind of calculation and he provided me 18 lakh rupees. He have given me what? 18 lakh rupees as leave salary. He have provided me how much? 18 lakh rupees as leave salary. Say, my last drawn standard salary, say it is 30,000 rupees. My last drawn standard salary is how much, friends? 30,000 rupees. Say these are the facts. And what is standard salary? Basic salary plus DA forms for the retirement benefit plus commission. It is expressed as a fixed percentage of your total. What is what? Standard salary. Are you all listening? Are you all listening? So my standard salary for the last month was how much? 30,000. Perfect. Now imagine, say the company have encashed my entire leave and given me what? 18 lakh rupees. Now we will check the limits. What was limit number 1? According to section 1010AA, what was limit number 1? 25 lakhs. Statutory limit of 25 lakhs. So there is nothing. You should simply write that 25 lakhs as limit number 1. Let's claim the exemption, okay? So limit number 1, say 25 lakhs. What is limit number 2? Actual leave salary received. How much is the actual leave salary received? 18 lakhs. What is limit number 3? 10 months salary. On the basis of last 10 months average, that's what they are saying. That simply means what? You take the last 10 months total standard salary. That's it. You simply take last 10 months total standard salary. How much is the last 10 months total standard salary? Last drawn standard salary is 30,000. That means last 10 months standard salary means 3 lakh. Then what is limit number 4? Limit number 4, what are they saying? Read that. Limit number 4, cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of his retirement. And while computing that, there is a note. What is that note? Earned leave entitlement cannot exceed 30 days for every year of actual service. So first of all, how many leave credit I actually have? What is my actual leave credit balance? I worked for 20 years. According to the company policy, the company provides 40 days of leave every year. So in total, it should be 800 days and I took 100 days of leave. I took 100 days of leave for altogether 20 years. So my leave balance according to the actual math is 700 days. Yes or no? Yes or no? My leave balance according to the actual figures and facts is 700 days. But I cannot take 700 days. What department says, what is this note? Read that note first. Earned leave entitlement cannot exceed 30 days for every year of actual service. According to the company policy, 1 year leave credit is how much? 40 days. But maximum I can take only up to 30 days. According to the income tax law, when you compute fourth limit, you consider only 30 days leave in a year, even if the employer is giving you a higher number of days. So here you have to restrict it to 30 days. So you tell me, according to the Income Tax Act, how many leave days credit I have? 20 years into 30 days a year. It is 600. From that I have already taken 100 days of leave. So it is 500 days. Are you with me? I need to encash that 500 days leave. I need to encash what? That 500 days leave. The figure that I'm getting while encashing that 500 days leave is limit number 4. Now the question is, how do I encash this 500 days leave? 500 days means how many months? 500 days divided by 30 days. How many months it will be? 500 divided by 30. 16.67. I will take 67. 16.67 months I have. Yes or no? Now, how do I encash it? I need to take a monthly salary. How do I take monthly salary? Based on last 10 months average salary. That simply means my last drawn standard salary is how much? 30,000. How do I take average? Into 10 divided by 10. Since there is no change in the salary figure, there won't be any change in the average as well. Are you with me? So, 30,000 last 10 months average means into 10 divided by 10, and that will be 30,000 itself. Are you with me? So, you have to take that 30,000 for the encashing purpose. So, 30,000 into 16.67, how much will be that figure? 5 lakh? 5 lakh 100 rupees. So, my fourth limit will be how much? 5 lakh 100 rupees, not more than that. Are you with me? Now, you have to take whichever is lower as the exemption. Now, you tell me which is lower. 3 lakh is the lower. And that's how I have to claim exemption under section 10(a). Now, we will read that last limit again. Can you read that last limit again? I want all of you to read it together. Cash equivalent of unavailed leave based on last 10 months average salary to his credit at the time of retirement. Wait, that simply means what? How many days of leave you have at the time of retirement? That days you take and encash it. How do you encash it? That days divided by 30 into last drawn, not last drawn, last 10 months average standard salary. Then you can encash it. But while encashing it, while computing the leave credit, you have to make sure one thing. What is that? 1 year leave policy shouldn't be more than 30 days. That is what is the notice. Earned leave entitlement cannot exceed 30 days for every year of actual service. Have you understood what I said? Have you understood what I said? So the point is very simple. If you are not a government employee, you should compute the exemption based on these 4 limits. Which all are the 4 limits? 25 lakhs, actual leave encashment received, then 10 months standard salary, and what is the 4th one? Cash equivalent of leave based on 10 months average standard salary. While computing that, you should consider one thing. 1 year leave credit shall not exceed 30 days. Are you with me? Are you with me? And pick the lower figure. This is how you have to compute the exemption under section 10(a). I hope this was also clear for you. Moving on, there are certain notes in relation to this. Okay, these notes are actually familiar for us. Note number 1. Do you remember under gratuity, I've told you that once I've retired from one employer, again I'm retiring from another employer. The maximum exemption that I can take over there was 20 lakhs. Do you remember that? Likewise, I'm retiring from one employer and I've got a leave encashment and I got an exemption. And I'm retiring again from another employer afterwards. Then the maximum exemption that I can claim will be 25 lakhs over here, because that is the statutory limit. The exemption that I've claimed earlier, I have to deduct it from that 25 lakhs if I'm retiring again and I'm receiving leave encashment again. Are you with me? Again, the concept is say the maximum exemption that a person can claim during his period of life is how much? 25 lakhs, not more than that, according to section 10(a). Whether I'm retiring from 2 employers in a year or different years, the concept is the same. Are you all with me? Are you all with me? It is similar to that note we have discussed under gratuity. There is a note again coming under leave encashment. Maximum exemption for a period in his lifetime will be 25 lakhs, not more than that. I hope that also was clear for you. Now, this is how you have to compute the leave encashment. So let's summarize. Let's summarize the concept of leave encashment. You tell me which is the section that provides exemption. 1010 AA. And if you want to claim exemption, the points are very simple. Either you have to retire, or it is a resignation or superannuation related leave encashment. Yes or no? Now, if you are receiving leave encashment during your period of service, it shall be fully taxable. You are not eligible for any exemption. If you are a central government employee or a state government employee, the entire leave salary that you got is fully exempted. If you are other sector employee, then your exemption shall be subjected to 4 conditions. You have to pick the lower of the 4. Number 1, 25 lakhs. Number 2, actual leave salary received. Number 3, last 10 months standard salary. Then point number 4, cash equivalent of leave credit at the time of retirement based on last 10 months average standard salary, and subjected to one more point. What is that one more point? Employer policy, whatever it is, the employer policy, 1 year leave entitlement shall not exceed 30 days. Is that okay? And pick the lower out of this 4, and that lower will be your exemption under section 10(10)(a). So friends, let's move on with the next component under the head salary, that is said to be treatment of provident fund. So listen, we are about to discuss the concept of treatment of provident fund. So let's understand what exactly is the treatment of provident fund. First of all, tell me, what do you mean by provident fund? What do you mean by provident fund? Say the employer and the employee will contribute some portion to a respective fund. At the time of retirement, the employee can withdraw it as a lump sum amount. It is just like creating a savings. Creating a savings for the employee after his retirement. Both the employer and employee will contribute that particular provident fund account. Are you all with me? Are you all listening? So to a respective provident fund account, both the employer will contribute and employee also will contribute. First of all, let's understand how a fund works. Okay, before starting with the Income Tax Act, let me explain you how a provident fund works. So listen, say there is an employer and there is an employee. This employer is paying this employee a monthly salary of say 10,000. Monthly salary say 10,000. Or we can say salary say 10,000. Now, when this employer gives this monthly salary to the employee, first of all, the employer will take, say, for example, rupees 1,000. Rupees 1,000 out of his pocket. What do you mean by out of his pocket? From employer's pocket, he will take 1,000 and he will deduct 1,000 from the employee's monthly salary. He will deduct what? 1,000 from the employee's monthly salary, and the employee will get only how much? 9,000 rupees net in his hands. Are you with me? So this 1,000, what will happen? Along with the 1,000 from his pocket and along with the employee's portion of 1,000, he will remit how much? 2,000 rupees to the provident fund account. He will remit how much? 2,000 rupees to a respective provident fund account. Are you with me? Are you with me? Now in the provident fund, that interest accrual will be there. For employer contribution as well as employee contribution, there will be interest accrued. At the time of retirement of the employee can withdraw that entire lump sum amount from that provident fund. This is how the scheme works. Are you with me? Are you with me? Now, this is the basic structure, or this is the basic concept of provident fund. This is how the scheme works. Now we are about to discuss the income tax implication of that respective scheme. What exactly is the IT implication of that respective scheme? That's what we are about to discuss right now. Are you all with me? So before getting into our detailed discussion, you should know that there are 4 types of provident funds. There are how many types? How many types? 4 types of provident funds are there. Number 1, it is said to be what? Statutory provident fund. Number 2, recognized provident fund. Number 3, unrecognized provident fund. And number 4, public provident fund. So, according to the law, there are 4 types of provident fund. One statutory, number 2, recognized provident fund, number 3, unrecognized provident fund, number 4, public provident fund. Let's understand what is the statutory provident fund first. You don't have to study this definition at all. You don't have to study the definition. It is only for your understanding. I'm explaining the definition. Are you with me? Now, what is statutory provident fund? Governed by Provident Fund Act 1925. It applies to the employees of government, railway, semi-government institution, local bodies, universities, and all recognized educational institution. If you are an employee who is either working with any government department or with a railway or semi-governmental institution or local bodies or university or other recognized institutions, you will be covered under statutory provident fund. You have to maintain provident fund according to the Provident Fund Act 1925. Are you with me? So all the provident fund which is maintained as per Provident Fund Act 1925 is said to be what? Statutory provident fund. Is that point clear? Is that point clear? Not yet over. Number 2, which is the second type of provident fund, recognized provident fund. Let's understand what exactly is this recognized provident fund. Means a provident fund recognized by the Commissioner of Income Tax for the purpose of income tax. It's a provident fund which is recognized by whom? Commissioner of Income Tax. Say for example, for this there are 2 options. Say I am a company, say JK Private Limited. I am a company called JK Private Limited. Okay? And there is a company called Tata Motors. Tata Motors Limited. There are 2 companies. Number 1, Tata Motors. Number 2, JK Private Limited. Listen, Tata Motors is actually a huge company. They have n number of employees with them. Yes or no? Yes or no? And JK Private Limited is, say, a mid-sized company. They have only 20-25 employees. So, JK Private Limited's employees are not covered under Provident Fund Act 1925. But they have to maintain Provident Fund. How? They have 2 options. Either they can maintain a fund account with any of the recognized institution in India, like LIC or other public financial institution. You can maintain a Provident Fund account. Or they can start a Provident Fund account by themselves, appoint trustees and get an approval from the Income Tax Commissioner. Are you with me? Are you with me? So for an entity, if they are not covered under Provident Fund Act 1925, they can maintain Provident Fund in 2 ways. Number 1, either they can maintain an account with any already recognized institution, or they can start a fund account by themselves and get it recognized. Normally, companies like Tata will start their own fund and they will appoint trustees. Since it is a huge company and they have huge number of employees, they will maintain their own funds and they will get a recognition from the income tax department by submitting application. A company like JK Private Limited, being a small sized entity, they will always prefer to maintain Provident Fund with any recognized institution. So both are called as what? Recognized Provident Fund. So it simply means either you got a recognition for your own fund or you're maintaining a fund with an already recognized institution. Who should recognize it? Commissioner of Income Tax should recognize it. If it is so, then that respective fund is called as what? Recognized Provident Fund. Are you with me? It means a fund which is recognized by Commissioner of Income Tax. Either you can maintain it by yourself and get it recognized, or you can already opt with a already recognized institution like LIC or other recognized public financial institution you can maintain. Are you with me? Now, what's the third fund? Unrecognized Provident Fund. You tell me, what will be unrecognized Provident Fund? What will be unrecognized Provident Fund? A fund which is not recognized by Commissioner of Income Tax is said to be what? Unrecognized Provident Fund. JK Private Limited started a Provident Fund by themselves, but they haven't submitted any application. They are calling it as what? Provident Fund. But from the perspective of income tax, it will be an unrecognized Provident Fund because they haven't recognized it yet. Are you with me? So unrecognized Provident Fund means a fund which is not recognized by the Commissioner of Income Tax. Now, moving on to the last one. What is the last one? Public Provident Fund. What is Public Provident Fund? Very simple. Say, listen. Imagine I'm a self-employed person. I'm what? A self-employed person. Say I'm a practicing chartered accountant. So I want to maintain a Provident Fund account. I want to what? Maintain a Provident Fund account. I can do so by opening a account with any nationalized recognized bank. With SBI, I can open a Public Provident Fund account. And I can deposit my own contribution. There will be interest benefit and there are certain deposit benefits that I will get. After some age, I can withdraw that entire money. Just like a recurring deposit, I myself can maintain a Provident Fund. That is called as what? PPF, Public Provident Fund. Normally, it have to be maintained with any recognized institution like a nationalized bank, SBI, ICICI, etc. You can maintain a PPF account. Are you with me? So, what is the definition? Operated under Public Provident Fund Act 1968. A membership of fund is open to every individual, whether you are an employee or not. You can open a PPF account by yourself. Are you with me? So, 4 types of provident funds are there. Repeat along with me. Number 1, statutory provident fund. Number 2, recognized provident fund. Number 3, unrecognized provident fund. Number 4, public provident fund. And there are certain abbreviations. Statutory provident fund is called as SPF. Statutory provident fund. Recognized provident fund is called as RPF. Recognized provident fund. And the other one, URPF. Unrecognized provident fund. And the last one, PPF. Public provident fund. So there are 4 types of fund: SPF, RPF, URPF and PPF. SPF is statutory, RPF is recognized, URPF is unrecognized, PPF is public. Are you with me? Now we are about to discuss. This is not Income Tax Act basically. The points till now we have discussed is not Income Tax Act. This is only Income Tax Act. What is the income tax implication when you deposit an amount to this provident funds and when you withdraw an amount from the provident fund? So we are about to discuss this in 2 ways. Number 1, at the time of deposit, and number 2, at the time of withdrawal. Are you with me? Are you with me? So we are about to discuss this in 2 ways. Number 1, at the time of deposit, and number 2, at the time of withdrawal. And let's see what is the treatment at the time of deposit first. After completing the treatment of deposit, we will discuss about the time of withdrawal. Both are important. Both are important for your examination. Definitely there will be some question from this topic. All the topics which we have discussed till now, that is started with the allowances, pension, gratuity, leave encashment, annuity they have never asked because there is no exemption at all. If there is annuity, you will simply write it under the head salary. There is nothing to do. So normally they don't ask. They usually ask allowance, pension, gratuity, leave encashment, provident fund, etc. Are you with me? Are you with me? After completing this chapter, I will give you a question which have adjustments of different items. Like in one question itself, there will be pension, gratuity, leave encashment, provident fund. So that kind of mixer question I can give, but only after completing this chapter, because it contains a lot of different part of this chapter. Okay. So let's understand what is the treatment when you deposit an amount with a provident fund. So tell me friends, what is SPF? Statutory provident fund. What is RPF? Recognized provident fund. What is URPF? Unrecognized provident fund. What is PPF? Public provident fund. So in every fund, there will be employer contribution, employee contribution, and its interest. That is the component of or source of fund of this provident funds. Sources of provident fund: employer contribution, employee contribution, interest on employer as well as employee contribution. Are you with me? So let's understand what is the treatment of employer's contribution when he contributes something to SPF. Listen. Say, I am your employer. Who? Who am I? I'm your employer. You are my employees. Okay. I am contributing some amount from my pocket for your benefit to SPF. I am contributing some amount from my pocket for your benefit to SPF. Are you with me? So you are getting a benefit. Why? Because it is going from my pocket and you will receive the amount in future. Future means at the time of your retirement or whenever you withdraw the amount from PF, you will get that amount. Yes or no? So according to what we have learned, it should be taxable because it is an indirect benefit received by my employee on account of our employer-employee relationship. Yes or no? Yes or no? And hence what department say, normally it should be taxable, but if the employer is depositing some amount to an SPF, it shall not be taxable. The employee is safe. Don't pay any taxes. That is the greatest advantage of maintaining a SPF. What is that? Statutory Provident Fund. You cannot simply go and open an SPF account. You have to be under that category. Then only you will be able to open a SPF account. Are you with me? If the employer is contributing something to statutory provident fund, that is not at all taxable in the hands of employee, not your. For employer, it's a cost. First of all, you should know what is income and what is cost. For the employer, it is a cost. Why the hell we should tax that in the hands of employer? Are you all with me? For employee, it is an indirect benefit, but department say not taxable. Are you all with me? Now, moving on to the next one. What is the next one? Employee's contribution. What is employee's contribution? Do you remember our example? From the hands of employee, he will deduct 1,000 and he will deposit it to the respective fund account. Are you with me? Now, there is an interesting thing. See, how much is the total income of the employee? In a month, how much is the total income of the employee? Is it 9,000 or 10,000? It should be 10,000. The total income in the hands of employee should be 10,000. But he is getting only 9,000 in his hands. Because 1,000 rupees, who deducted? Employer deducted on account of employee's contribution to the respective fund. Yes or no? But no way, you have to show that entire 10,000 as your income. You have earned 10,000. The 1,000 is what? Your PF contribution. Are you with me? Are you with me? So the employee will say it's a hardship. I am receiving only 9 in my hands and I am supposed to pay taxes for 10,000. So department say don't worry. You do one thing. You show 10,000 as your income and claim that 1,000 rupees as what? A deduction. Deduction under section 80C, which is under chapter 6A. Chapter 6A deduction. 80C is the first chapter, 6A deduction. Tell me from which income we deduct chapter 6A? From gross total income. How do you get gross total income? How do you get gross total income? You add income from 5 heads. Do you remember the chart that we have drawn on the day 1? If income is taxable, you have to bifurcate it into 5 heads: salary, house property, PGBP, capital gain, IFOS. After processing, you have to add everything together. You will get gross total income. That gross total income computation is subjected to clubbing and set off and carry forward provision. From the gross total income, you less chapter 6A deduction. Do you remember this? Out of this chapter 6A deduction, the first deduction is 80C deduction. So the point is, while computing salary income, your income is 10,000. But while computing the total income, you can claim that 1,000 rupees paid from your pocket as a chapter 6A deduction. Specifically under which section? 80C. Are you with me? Are you with me? So you have to claim that 80C as a chapter 6A deduction. Then you compute the total income, compute the taxes by applying the rate, compute the basic tax, etc. etc. Are you all with me? This is the way that you have to compute a amount. So coming back to the point, you tell me what is the treatment for employees contribution? Eligible for deduction under 80C. Why? You are writing that entire 10,000 as your salary income. From that you can claim deduction under 80C, but only after computing other head income and computing the gross total income only you are supposed to deduct 80C. Are you with me? We are studying an act, a rule. If they are saying deduct it from that place, you should deduct it only from that place. Don't apply your mathematical logic over here. Anyways, we will get deduction. So, anga panna enna, inga panna enna. If you deduct it from here, you will get mark. If you deduct it from there, you will not get mark. Department say you deduct it from a particular point, you are only supposed to deduct it from that respective point. Otherwise, no marks in exam. Are you with me? But mathematically, you can say that my answer was right, but I didn't qualify. Not a problem. Is that a problem? Of course, yes. Your answer should be right. You should get marks and you should qualify as well. Are you with me? All are important. So, you have to deduct this amount of employees contribution under 80C, under chapter 6A. Chapter 6A. Write it again. Chapter 6A. That is V1. What is V1? That Roman numeral 6. And alphabet A. It is called as chapter 6A deduction. Now, what will happen to the interest component, friends? What will happen to the interest component? On the employer contribution as well as employee contribution, there will be interest accrued every year, and that entire interest shall be fully not taxable. Are you all listening? We are discussing about which fund? We are discussing about which fund? Statutory Provident Fund. You tell me what is the treatment for employer contribution? Not taxable. Employee contribution claimed as a deduction from 80C chapter 6A. You know the point. From GTI only you are supposed to deduct it. Then what is the treatment for interest component? Not taxable. Happy. Employer contribution not taxable. Employee contribution you can claim a deduction, and the interest is also not taxable. Are you all with me? Is that point clear till now? Is that point clear till now? Okay. Now we will move on to the next fund. What is the second fund? That is said to be RPF. You tell me what is the full form of RPF? Recognized Provident Fund. Let's see what is the treatment of employer contribution, employee contribution, and its interest. First, we will deal with the employer contribution. Tell me what is the treatment of employer contribution? You can claim an exemption, but only up to 12% of salary. Can the employee claim an exemption for whatever amount contributed by the employer? No. There is a limit for the exemption that an employee can claim. And how much is the limit? How much is the limit? 12% of his salary. You first compute your salary. Take 12% of that salary. Up to 12%, if the employer contributes, you can claim exemption. More than that, if the employer contributes, that excess shall be taxable as salary. Are you with me? Are you with me? Now there is a problem. What do you mean by salary there? Salary means basic salary plus DA forming part of retirement benefit only to be considered, plus commission as fixed percentage on turnover. This definition is also called as standard salary. So basic salary plus DA forms part of the retirement benefit plus commission if it is expressed as fixed percentage of your total turnover. This is said to be what? Standard salary. Are you with me? Are you all with me? Yes. So up to 12 percentage of standard salary, you can claim exemption for employer contribution to recognized provident fund. Are you with me? In relation to SPF, it was very simple. Whatever employer contributes was fully not taxable. But in case of RPF, it is not like that, only up to 12 percentage of salary. That is standard salary. Is only allowed as exemption. The rest will be taxable. Now you tell me, what's the treatment for employees' contribution? Same as that. Eligible for deduction under 80C. Because that employee's contribution also will form part of taxable salary. From that he can claim chapter 6A deduction under section 80C. Are you with me? Treatment is same for SPF and RPF. How about interest? How about interest? Exempted, but only up to 9.5 percentage per annum. That is the interest rate. Any excess interest shall be taxable as on the fund balance. The maximum rate of interest that is allowed as deduction is how much? How much? 9.5%. Say your actual interest is 12%, then what will happen? That 2.5% interest shall be fully taxable as salary. Are you with me? Are you with me? So the point is very simple. Employer contribution, you can claim an exemption, but only up to 12% of your standard salary. Employee contribution is allowable as a deduction under 80C. Interest only up to 9.5% of what? You will get interest on what? Fund balance. Yes or no? So interest on that fund balance up to 9.5% is allowed as exemption. Excess, if any, have to be considered as the part of your taxable salary and taxable under the head salary. Are you with me? Are you with me? All right. So that is the treatment of RPF. What was RPF? RPF. It is recognized provident fund. Moving on to the treatment of the next item. What is that? URPF. What is URPF? Unrecognized provident fund. Income tax department don't know that there is a provident fund. They have no information in relation to a provident fund. You tell me, what is the treatment of employer contribution to unrecognized provident fund? Not taxable. Why? Because department don't know that there is a provident fund. What will happen to the employee contribution? Not eligible for deduction because department don't know that there is a provident fund. That is called as unrecognized provident fund. Yes or no? And what will happen to the interest? Not taxable. So which is better? Recognize the unrecognized the. Don't say unrecognized. Why? Because at the time of withdrawal, there will be huge taxability. This is only at the time of deposit. Now after this, we have to discuss the at the time of withdrawal impact. At the time of withdrawal, the taxability will be huge in URPF. And most of the cases, it is exempted in SPF, RPF and PPF. Withdrawal is exempted in SPF, RPF and PPF. Subject to conditions, but fully taxable and from URPF. So employee will face a hardship when he withdraw the amount. So always better to maintain recognized provident fund itself. Are you with me? Perfect. So moving on to the next one. What is the next one? Last one. It is PPF. You tell me, what is PPF? Public Provident Fund. Employer contribution, what is the treatment? Not applicable. Why? Normally self-employed persons will maintain a fund for their own benefit. Yes or no? There won't be any employer contribution to a PPF. I've told you, I'm a self-employed person. Practicing chartered accountant. I don't have an employer. I maintain PPF for my own sake. To that PPF there is no employer contribution because I don't have an employer. Are you with me? Are you with me? And hence we can say for employer contribution is not applicable over there. Perfect. Now, how about employee's contribution? What's the treatment? Eligible for deduction under 80C. We cannot say employee, that person's contribution. Rather than saying employee contribution, it is better to say that on contribution. on contribution is eligible for a deduction under 80C. And what will happen to the interest? What will happen to the interest component? Nothing taxable. So let's summarize. We have discussed about 4 types of provident funds. Number 1, statutory provident fund. Number 2, recognized provident fund. Number 3, unrecognized provident fund. Number 4, public provident fund. You tell me, what is the treatment of employer contribution to SPF? Nothing taxable. RPF, up to 12% of standard salary exempted. URPF, nothing taxable. PPF, no employer contribution. Now we will deal with employee contribution. Employee contribution of SPF, eligible for reduction 80C. RPF, state, eligible for reduction 80C. URPF, no reduction. PPF, eligible for reduction under 80C. Next one, interest. SPF, not taxable. RPF, exempted but only up to 9.5% on the fund balance. Then URPF, not taxable. PPF, fully exempted, not taxable. Are you with me? Is that point clear? We have done with the deposit part. Now we have to deal with the withdrawal part. Withdrawal part is also easy. If you are properly attending the class, you will learn it from here itself. If you are properly attending the class, you will learn from here itself. So let's see. At the time of withdrawal, what is the treatment? Let's see. So we will consider it separately. So first of all, we will deal with the recognized provident fund, public provident fund and statutory provident fund. After completing these 3, we will deal with what? Unrecognized provident fund. Okay. So first let's complete SPF, PPF and RPF. Thereafter we will jump to URPF. Are you all listening? Are you all listening? Okay friends, so let's see. The payment received by an assessee from the following funds at the time of retirement or otherwise would be fully exempted from tax under section 10 subsection 11 and 10 subsection 12. So listen, if you are withdrawing anything, you have to listen carefully. Are you all listening? Now we are discussing about what? Withdrawal. Who withdraws money? Employee. It is his account only. Are you with me? So employee at the time of his retirement or on account of his death, if he is withdrawing money from SPF or PPF, exemption is under section 10 subsection 11. Let's see what exactly is that particular exemption. The payment received by an employee, that means by an assessee, from SPF or PPF at the time of retirement or otherwise would be fully exempted from tax. Under which section? Under which section? 10 subsection 11. Whatever amount that you withdraw from SPF or PPF shall be fully exempted. Now think about SPF. At the time of deposit, it was fully exempted. And for the employee contribution, you can claim a deduction as well. Now at the time of withdrawal, nothing shall be taxable. So it is a complete exemption rate. You deposit and claim the benefit and withdraw, nothing shall be taxable. Are you with me? So the government is also supporting the savings behavior of employee. You save more money for your own retirement. Otherwise, after retiring, you will come and ask the government for the help. You are not taxing from it, anything from it. You take it by your own and you be your own. Are you with me? Are you with me? Alright, so the point is, what is the point? The payments received by an assessee from SPF or PPF at the time of retirement or otherwise would be fully exempted from tax. Are you with me? It is fully exempted from tax. Which section? Section 10 subsection 11. It is as simple as that. You withdraw any money from SPF or PPF, everything shall be fully exempted. Don't worry. Now, what if you are withdrawing money from RPF? What is RPF? What is RPF? Recognized Provident Fund. So friends, if you are withdrawing any money from recognized Provident Fund, so let's understand what is going to be the income tax implication on that. So section 10 subsection 12 says accumulated balance payable to an employee participating in RPF shall be exempted in any of the following circumstances. So if you are withdrawing money from RPF, you can claim an exemption, but only in this 4 circumstances. Are you with me? If you are withdrawing money in any other case, that withdrawal shall be taxable. And how it is taxable, that I'll tell you later. Are you with me? So right now we are discussing about what? Withdrawal from? Right now we are discussing about withdrawal from RPF. What is RPF? Recognized Provident Fund. If you are withdrawing money from recognized provident fund, then you can claim an exemption under section 10 subsection 12. But only in this 4 circumstances. Which all are the 4 circumstances? Number 1. Employee retires or terminates job after 5 years of continuous service. What is that? You are retiring after 5 years and you are withdrawing the money from RPF. Nothing shall be taxable. You can claim full exemption. You with me? So mostly it will be exempted already. In most of the cases it will be 5 years of continuous service is comparatively very less only. So if you have at least 5 years of continuous service, then we have no plans to tax anything. The entire withdrawal shall be fully exempted. Are you with me? Are you with me? Yes. Let me ask you one doubt. Say I am working in a company. I am working in Reliance. I am working in Reliance. On my 3rd year, I got frustrated. I got what? Frustrated. Okay? And I put a resignation letter. I put what? A resignation letter. So I don't have 5 years continuous service. I don't have what? 5 years continuous service. Then on the 3rd year, if I'm retiring, then the amount that I'm getting at the time of retirement shall be taxable. I cannot claim the exemption because I should have minimum 5 years continuous service. Yes or no? Yes or no? If I'm retiring on 3rd year, then department comes up with a solution. What is the solution? That is the 3rd one. We will complete the 3rd one. What is that? Employee has resigned before completion of 5 years and joins another organization. I've resigned from Reliance and I've joined Tata. Are you with me? I've retired from or resigned from Reliance, then I joined Tata. In that case, what will happen? Joins another organization who also maintains RPF, then his fund balance with the current employer is transferred to the new employer also. Nothing shall be taxable. That simply means I resigned from Reliance on my 3rd year, but I haven't withdrawn RPF balance. Rather, I transferred my RPF balance from Reliance to Tata. Are you with me? Rather than withdrawing my RPF, I transferred that balance from Reliance to Tata. Nothing shall be taxable. Nothing shall be taxable. Are you with me? Are you with me? Now let me tell you one more example. After working with Tata for 3 years, I've resigned or retired forever. After working with Tata for another 3 years, I've retired for ever. Now how many years of continuous service I have? I can take 6. 3 with Reliance, 3 with Tata. It is not 3 with Tata alone. I can take my whole service period. Have you understood what I said? Have you understood what I said? So when you count the period of service, it is not only with one employer. You can take the past employer period of service as well. That was my point. Are you with me? Perfect. So that was the 3rd one. Now, how about the 2nd one? Listen. The employee retires or terminates job before 5 years of continuous service by a reason of his ill health. That employee has some health issues. That's why he retired on 3rd year and he withdrawn the balance. Is that a problem? No. Nothing shall be taxable. If you are retiring on 3rd year or 4th year before 5th year and you are withdrawing money due to your ill health, we are not that cruel. Nothing shall be taxable. We are giving up our taxing right on that event as well. Are you with me? Are you with me? The next one. By a reason of contraction or discontinuance of employer's business. What is contraction or discontinuance? There was a huge economic crisis in India. So a lot of layoffs happened. A lot of what? Layoffs happened. I also lost my job on my 3rd year and I'm not getting any other job. That is why I have withdrawn the money. Are you with me? It is due to the contraction or discontinuance of employer's business. Are you with me? In that case also I'm withdrawing money, nothing shall be taxable. Then, what's the last one? Any other reason beyond the control of employee. Any other reason beyond the control of employee, I am supposed to withdraw the money. Say like Corona, something like Corona happened. And there was a kind of a lockdown for 1 year. Okay, there is a lockdown for 1 year. What will happen? The company will terminate most of the employees and they will only work with the basic minimum employees. Are you with me? In such a case and all, I lost my job, no problem. I can withdraw the money and nothing shall be taxable. Are you with me? So what is the second point? Employee retires or terminates job before 5 years of continuous service by a reason of his ill health or by a reason of contraction or a discontinuance of employer's business or any other reason beyond the control of employee, then nothing shall be taxable at the time of withdrawal. Are you with me? So 3 scenarios we have discussed. Number 1, 5 years of continuous service. Number 2, transfer from old employer to new employer. Number 3, ill health, discontinuance of business or any other reason beyond the control of employee. Nothing shall be taxable. And one more is there. What is the last one? Can you read that last one? Entire balance outstanding to the credit of employee is transferred to his account under pension scheme. That is called as NPS, National Pension Scheme, referred under 80 CCD. That simply means, listen, on the 3rd year with Reliance, I have retired forever. On the 3rd year, I have retired forever. Yeah, on the 3rd year, I have retired forever. And what I did is like, rather than withdrawing the money, I transferred my RPF balance to National Pension Scheme. There's a thing called NPS. It is called as National Pension Scheme, referred under 80 CCD of income tax. We will learn that when we discuss which chapter? Chapter 6A, deduction. Are you with me? Alright, perfect. So let's continue. At the time of retirement on my 3rd year, rather than withdrawing the money, I transferred the balance from my RPF to NPS. What is NPS? National Pension Scheme. As I said, we will discuss it under chapter 6A, deduction. There's a thing called 80 CCD deduction. NPS contribution deduction that we will learn in chapter 6A. For the time being, understand it as a special account that is called as National Pension Scheme account. Are you with me? So 4 scenarios. Number 1, 5 years of continuous service. Number 2, from old employer to new employer. Number 3, ill health, contraction or discontinuance of employer's business. Then any other reason beyond the control of employee. And finally, I'm transferring that RPF balance to NPS. In all these 4 scenarios, nothing shall be taxable. What if I'm withdrawing money by simply resigning? It shall be taxable. That's what we are about to discuss. In any other case, amount withdrawn shall be taxable as in the case of URPF. If you are withdrawing money from RPF in any other circumstance, then we will tax that withdrawal similar to URPF withdrawal. Now, what is URPF withdrawal? That we will learn later. Okay, URPF withdrawal that we have to discuss later. That is the next topic. Are you with me? So the point is very simple. If you are withdrawing any money from where? RPF. In the 4 circumstances, nothing shall be taxable. You are withdrawing money in any other circumstance apart from the 4, then what will happen? That withdrawal will be taxable similar to the withdrawal from a URPF account. That's what the department says. Are you all with me? Have you understood what I said? So 3 things: SPF, PPF and RPS subjected to 4 circumstances shall be fully exempted. Withdrawal shall be fully exempted. And section was 1011 and 1012. 1011 was SPF and PPF. 1012 was RPF. Are you with me? Now there are 2 notes. 2 notes, not 2 notes, 3-4 notes. What is note number 1? Can you read note number 1? Exemption under 10 subsection 11. What is that? Withdrawal from SPF and PPF exemption. Or 10 subsection 12. What is that? Withdrawal from RPF. Would not be available in respect of income by way of interest accrued during the previous year to the extent it relates to the amount or aggregate the amount of contribution made by employee exceeding 2,50,000 in any previous year in SPF or RPF on or after 1st April 2021. Can you read that again? Exemption under 10 subsection 11 or 12 would not be available in respect of income by way of interest accrued during the previous year to the extent it relates to the amount or aggregate the amount of contribution made by employee exceeding 2.5 lakhs in any previous year in SPF or RPF on or after 1st April 2021. What does that mean? Listen, I am an employee. So there is an employee and this person is withdrawing money from, say, SPF or RPF, whatever it is. Are you all with me? Are you all with me? At the time of withdrawal, which all are the components of income? The withdrawal, you will get a lump sum amount. That lump sum amount is on account of employer contribution, employee contribution, interest on employer contribution, interest on employee contribution. Yes or no? So the withdrawal amount is the mix of employer contribution at the time of period of service, employee contribution at the time of period of service, interest on employer contribution and interest on employee contribution. Are you with me? Now imagine a situation. Say I am the CEO of a particular company. I am a CEO of a respective some company, some XYZ company. I am earning an annual salary of around 5 crore. I am earning an annual salary of how much? 5 crore rupees. I want to save more taxes because on 5 crore, you know, say I am earning an income of 10 crore. Okay, we'll make it 10 crore. If it is 10 crore, you know, my surcharge will be 37%. Yes or no? My surcharge will be what? 37. My highest rate of tax will be around 30%. My surcharge will be 37. And effectively, I am supposed to pay cess on 4%. So effective rate will be somewhere near to 40%. Effectively, if you compute, it will be 42.744% or something. Effectively, I am supposed to pay 40% as what? Income tax. It will be a kind of a heart attack for me. I am earning 10 crore due to my skill and I am supposed to pay 4 crore plus as what? Income tax. Not over, plus GST also I have to pay. When I spend that 6 crore, I have to pay GST. That we cannot do anything. Okay. So leave that part. We'll think about income tax. So the employee got an idea. What is the idea? I'll do one thing. I will contribute more amount to RPF or SPF. The employee can contribute according to his wish. There is no limit for the employee contribution. The employer always will limit because it is from his own pocket. Okay. So the employee thought of contributing more amount to where? Provident fund, either SPF or RPF. If I contribute more, then what is the advantage? First of all, I can claim deduction for the amount that I am contributing. Yes or no? But that deduction have a ceiling limit. Forget about the ceiling limit. But still, the amount, if I contribute more amount, I can claim what? More deduction. Yes or no? So that I can bring my taxable amount less. I can make it less because I can claim more deduction. Are you with me? Plus one more advantage is there. That more amount that I contribute, I will get interest on that amount. Interest along with the contribution is untaxed at the time of withdrawal. Yes or no? That interest along with the contributed amount shall be untaxed at the time of withdrawal. The only point is I have to continue. I should have a continuous service of 5 years. Being CEO of a company, I'm not a fresher employee. I qualified yesterday, today I become CEO. Is that possible? No, that is not possible. Okay, so rarest of the rare case and all, it may be possible, depends upon the size of a company or startup and all, maybe it is possible. Okay, no, for a normal company, normally a CEO will have definitely what, 5 years of, more than 5 years, what 5 years, 10-15 years of service experience will minimum he have. Are you with me? So I thought of contributing more amount to RPF or SPF so that all the interest will go untaxed. If I deposit that amount in bank, for the bank interest, I have to pay income tax again. Are you with me? I'm receiving 10 crore with me. Okay, I have some basic income to leave. I thought of investing the rest of the income with RPF. If I deposit the rest of the income in bank, on bank interest, I have to pay income tax. Here I will get interest up to 9.5% is exempted. Plus, at the time of withdrawal, everything shall be again exempted. Are you with me? So people were doing this, especially high salaried persons were depositing huge amount as employee contribution and taking the benefit of the withdrawal exemption. So department said, podum, bus, we are limiting it. What is the limit? If an employee in a year contributes more than 2,50,000, if an employee in a year contributes how much? More than 2,50,000, there is a problem. What is that problem? Say he contributes 10 lakhs. He contributes what? 10 lakhs. In a year, we are talking about yearly contribution. Are you with me? In a year, if I am contributing more than 2,50,000 and I will get interest on that entire contribution. Yes or no? And how much is my entire contribution? 10 lakh. Now, department say, how much is my excess contribution? 7,50,000. The interest that I am getting on this 7,50,000 shall be fully taxable in the hands of employee at the time of retirement. On that excess contribution interest, you cannot claim the benefit of 10 subsection 11 and 10 subsection 12. Not possible. Are you with me? Are you with me? So you tell me the limit of exemption is for which component? The limit of that 1011 and 1012 exemption is for which component only? Employee contributions interest. That too, if it exceeds 2,50,000 in a year. Are you with me? If an employee is contributing more than 2,50,000 in a year and is receiving interest for that excess contribution, that excess contributions interest shall be fully taxable in the hands of employee at the time of retirement or withdrawal, whatever it is. Are you all here? Otherwise, these high income earning individuals will contribute more and they will interest on that excess contribution and they will claim income tax benefit at the time of withdrawal and they will say nothing shall be taxable. This is how you aggressively plan taxes. Not aggressive, this is permitted only. Everybody was following this. So income tax department understood. We understood your strategy. So we are bringing a limit for this. Are you with me? Yeah. So let's read that note again. Can you read that note again along with me? Note 1. What is that? Exemption under section 10 subsection 11 or 10 subsection 12 would not be available in respect of income by way of interest accrued during the previous year to the extent it relates to the amount or aggregate of the amount of contribution made by employee exceeding 2,50,000 in a previous year in SPF or RPF on or after 1st April 2021, because they brought in this limit with effect from 1st April 2021. Before 1st April 2021, everybody was taking this benefit. You take it, we have no problem, because it was not there in Income Tax Act. From 1st April 2021 onwards, you contribute taxes, interest on excess shall be taxable. That's it. Are you with me? Is that point clear? Perfect. Moving on to note number 2. What is note number 2? In case of contribution to PPF, the limit is 5 lakh. What is limit is 5 lakh? In the case of contribution to PPF, you are contributing more than 5 lakh, then interest on that excess contribution over and above 5 lakh will be taxable at the time of withdrawal. That means instead of 2.5, the limit is 5 lakh if it is a contribution to PPF. Are you all listening? So there is a change in the limit. If the provident fund is what? PPF. What is PPF? What is PPF? Public Provident Fund. If that fund is a PPF account, there is a change in limit. And how much is the limit? Instead of 2.5, it is 5 lakh. Is that clear? Hope you understood why there is a limit as well. Now, moving on. What is not number 3? It may be noted that interest accrued on contribution to such funds up to 31st March 2021 would be exempted without any limit, because this new mandate or new ceiling came with effect from 1st April 2021. So whatever deposit that you have done, excess deposit that you have done before 31st March 2021, we are not considering it. You do whatever you feel like. But from now onwards, from April 1st 2021 onwards, we are strict. Excess contributions interest shall be fully taxable at the time of withdrawal. Are you with me? Moving on. What is not number 4? If after termination of employment with one employer, the employee obtains employment under another employer, then only so much of accumulated balance in his provident fund account will be exempted, which is transferred to his recognized provident fund maintained by the new employer. And at the time of termination for counting 5 years of continuous service, the period of service with the former employer also shall be taken into account. That we have already discussed. 3 years from Reliance, 3 years with Tata. Altogether 6 years. That is what is not number 4 and 5. I'm terminating from one employer and joining another company. So when I count the total period of service, I can take the former employees and later employees period of service together. Are you with me? Are you with me? So this is how you compute the benefit, or this is what is the income tax implication if you contribute something to RPF, PPF, URPF, SPF. And we understood the income tax implication on withdrawal from SPF, PPF and RPF, not URPF. URPF is the next topic. Are you with me? Have you understood this much? So friends, now withdrawal from URPF. What is URPF? Unrecognized provident fund. If you are an employee withdrawing money from URPF, and what is URPF? Unrecognized provident fund, then let's understand what is the income tax implication and what department says. Listen. See, this URPF have 4 components. Which are the components? Number 1, employer contribution. Number 2, employee contribution. Number 3, interest on employer contribution. Number 4, interest on employee contribution. Are you with me? Whenever an employee withdraws money from URPF, there can be 4 components. Employer, employee, interest on employer, interest on employee. Are you with me? Let's understand what is the treatment for each and every component. First component, accumulated employer's contribution. Are you with me? Are you with me? Listen, if you deposit an amount to URPF, if your employer, say I'm your employer and you are my employee, if I'm depositing an amount to URPF, what was the treatment that we have learned earlier at the time of deposit? Nothing shall be taxable in your hand. At that time I've told you, everything shall be taxable at the time of withdrawal. Yes or no? So what is the treatment? Fully taxable under the head salaries. If at the time of withdrawal, if there is an accumulated employer's contribution have been withdrawn, then everything shall be taxable under the head salary. When an employee withdraws money from URPF, out of that URPF, employer's contribution shall be fully taxable. Under which head? Under which head? Salaries. At which moment? At the time of withdrawal. At the time of withdrawal, under the head salaries, that entire employer's contribution shall be fully taxable. How about employee's contribution? The accumulated employee's contribution not taxable. Why? Because it is contributed from a salary. Yes or no? Do you remember? See, that example, his total contribution from his pocket was 1,000. What was that example? Yeah, this was the one. Your contribution was 1,000 and already department have taxed 10,000 as salary. At the time of contribution, no deduction for you. And hence, at the time of withdrawal, nothing taxable. It is just like you are depositing your money somewhere and taking it back. At the time of deposit, no deduction. At the time of withdrawal, No taxability, because that fund has been already a part of your taxable salary. Are you with me? Yes. Are you with me? So you tell me, what is the treatment for employee contribution? Not taxable. At the time of retirement, when you are withdrawing an amount, employee contribution shall not be taxable. Now, moving on to the next one. What is the next one? Interest on employer contribution. Tell me, what is the treatment? Fully taxable. Under which head? Under the head salaries. If you have an interest on employer's contribution, that interest also shall be fully taxable under which head? Salaries. Now you tell me, what is the treatment for employees contribution interest? Accumulated interest on employees contribution shall be fully taxable, but which head? Income from other source. Because from the perspective of income tax, you have deposited some money somewhere and you're getting some interest, because that fund is not recognized by the department. So that interest income have to be taxed under IFO. Yes. Are you with me? Comparatively, this is very easy. So whenever you are withdrawing amount from URPF, you tell me, what is the treatment for employer contribution? Fully taxable under salary. Employee contribution not taxable. Interest on employer contribution taxable under salary. Interest on employee contribution taxable under IFOS. And when you are withdrawing money from RPF, apart from the four circumstances, hope you remember, that withdrawal shall be taxable as if it is similar to URPF, as if it is a withdrawal from URPF or similar to URPF. This is what is the treatment. Employer contribution salary, employee contribution no taxability, employer contributions interest salary, employee contributions interest income from other source. Are you all with me? Are you all with me? This is what is the treatment of PF, provident funds, and we have discussed all the four types of provident funds. We have understood the treatment of the deposit and we have understood the treatment of withdrawal as well. What is the next component that we have to discuss? Pretty easy. Treatment of retrenchment compensation under section 1010P. That's what we are about to discuss. Are you all listening? Tell me, friends, what do you mean by retrenchment compensation? What is retrenchment? Retrenchment simply means kind of a layoff. Are you with me? Say, I am terminating you from the service due to maybe my financial crisis or due to the economic crisis in the country or due to many other reasons. I am terminating you, not on account of your fault, okay? Maybe due to some general condition, I am retrenching my employees. It's a kind of a layoff. Are you with me? Should I say tata bye-bye to you? Simply tata bye-bye. Okay, you will get a better job. You will get a better job. This job is not enough for you. You will get a better job. Should I say like that and say tata bye-bye? No. I should pay him a compensation. Are you with me? That compensation which is paid by the employer to the employee at the time of retrenchment is said to be what? Retrenchment compensation. Are you with me? Compensation paid by the employer to the employee at the time of retrenchment is said to be what? Retrenchment compensation. And there is an employer-employee relationship when an employee receives retrenchment compensation. Hence, it has to be taxable under the head salary. But the employee can claim an exemption under section 1010B of Income Tax Act. That's what we are about to discuss right now. Are you able to follow what I'm saying? So, exemption shall be lower of. You should take the lower of these two. Which all are these two? Item number 1. 15 days average pay into completed year of service and part thereof in excess of 6 months. Are you with me? Yes. Read that first one. 15 days average pay into completed year of service and part thereof in excess of 6 months, or rupees 5 lakh. Whichever is lower shall be the exemption. Rest shall be fully taxable. Or if there is any balance after claiming this exemption, the balance shall be fully taxable. Are you with me? Are you with me? 15 days average pay. Now the question is, what is this average pay? So for computing average pay, there is a big computational format it is given. Not at all important for your exam, but still, let's cover this as well. Okay, let's not leave or let's not spare anything. We don't know. Maybe in the next attempt, they may ask a question from this. They haven't asked yet. That doesn't mean that in future, they will never ask. The chances are very less, but still, let's study this as well. Now, how do you compute the average pay? Can you read that first box? Average pay means average of wages payable to a workman. Very simple. Average pay means what? Average of the payables given to a workman. How do you compute that average? In case of monthly paid workman, that means you are a workman in my industry and you are getting paid monthly. Normally all the salaries are getting paid monthly only. Yes or no? If we are paying you monthly, then what is that average pay? Average wage of 3 complete calendar months. That means just before the retrenchment, the past 3 months average monthly salary shall be considered into 15 days, into complete year of service or part thereof in excess of 6 months. Are you with me? Are you with me? So if in an industry you are employees who are getting monthly salary, then average pay means last 3 months average. How do you compute last 3 months average? Total 3 months divided by 3. Are you with me? Then what if you are a weekly paid workman? There are certain industries where they make payment weekly. Are you with me? If you are a weekly paid workman, then average of 4 calendar weeks salary you have to consider. Then you have to consider what? Average of 4 calendar weeks. Are you with me? What if you are a daily paid workman? Then average of 12 full working weeks. Average of 12 full working weeks you should consider. If you are a daily paid person, then you have to consider average of 12 full working weeks. So this is what the department says. So monthly paid, average of last 3 months. Weekly paid, average of 4 calendar weeks. Then daily paid, average of 12 full working weeks. Perfect. Now, where such calculation cannot be made, average pay shall be calculated as average of the wages payable to a workman during the period he had actually worked. If in any other scenario you are not able to make these kinds of computation, then what you need to do? You need to take the average of wages payable to the workman during the period he actually worked. There are certain seasonal establishment where you don't have daily work. Are you all with me? There are certain seasonal establishment where you don't have daily work. Say today you have work. After 3 days you have another work. If it is something like that, then you take the average of that respective period. That entire period you take the average. Then wages for this purpose means all remuneration capable of being expressed in terms of money payable to a workman. Wage means what? Your basic salary plus DNS allowance, value of any house accommodation or supply of light, water, medical attendance, other amenity of any other service or of concessional supply of food grains, other articles, travel concession, any commission payable on promotion of sales or business or both. You have to add all these components to salary for computing this average pay. Are you with me? Which are the things to add? Number 1, DNS allowance. Whether forms part of retirement benefit or not, you have to add the DNS allowance. Number 2, value of house accommodation. If the company have given you what? A small house to stay, the value of that house accommodation also have to be considered. How to value that? That we will learn in perquisites. Are you with me? Then, value of supply of water, light, medical attendance, other amenity of any other service or of concessional supply of food grains, other articles, etc. You are giving some food grains or other articles, the value of that also have to be considered. The employer is giving you 1 kg of rice every month. Maybe every week. Then you have to take what? The value of that 1 kg rice as well as a part of your taxable salary for computing this average pay. Are you with me? Now, travel concessions given by the employer to the employee have to be considered. Commission payable by the employer to the employee for the promotion of sales or business or both. Now, you are not supposed to add what? Bonus, contribution to retirement benefit or any gratuity payable on the termination of a service. That shouldn't be a part of your average pay while doing the calculation. You should exclude these items and you should include these items for computing the average pay. Why we are computing average pay? Because the exemption is 15 days average pay for completed year of service or part thereof in excess of 6 months or rupees 5 lakh, whichever is lower. For that you should have an average pay. Yes or no? Yes or no? How do you find out the pay? Pay means basic pay including this and excluding this. If you are a monthly paid employee, then take average of 3 completed calendar months. Weekly paid 4 calendar weeks. Daily paid 12 full working weeks. This is what the department says. Are you with me? And we don't have any question because it has not been tested yet. And there is a note under that. What is that note? Can you read the note? Above limits will not be applicable to cases where compensation is paid under any scheme approved by central government for giving special protection to workmen under certain circumstances. If the compensation is given by the government for the protection of a particular industry, the above limits are not applicable. That shall be fully exempted. Are you with me? So this is what is called as treatment of retrenchment compensation. For our examination purpose, I am not saying that this is very important because they have never tested this. We only have theory part of it. Are you with me? Are you with me? So you tell me, how do you compute exemption under 10-10D? Either 15 days average pay into completed year of service or part thereof in excess of 6 months or rupees 5 lakh, whichever is under which section? Section 10-10B, or rather we can say 10 subsection 10B is the exemption. Are you with me? Bus. Moving on to the next one. Next one you have to study, plus they have tested in exam and we will solve that question as well right now. So what is the next heading? Can you read the heading? What is the heading? Treatment of voluntary retirement receipts, which is under section 10 subsection 10C. First of all, you should know what is this voluntary retirement receipt. Any idea? Have you heard about voluntary retirement? Voluntary retirement simply means, say my retiring age is 60, but I'm retiring at the age of 50. I'm saying to my employer, Podu appa, I'm done with you. You are pushing me, work like a slave. Podu. I want to, what? Nimmadi venu. I want some peace in my life. I don't want these kinds of work burden. Are you with me? So if you are retiring before your age, your employer will simply say tata bye bye. No, he will give you a compensation, and that is said to be what? Voluntary retirement receipt. Not compensation, it is just like a retirement benefit. Are you with me? Yes, are you with me? If you are voluntarily retiring before your age, then your employer will give you a receipt or a amount, a lump sum amount. That amount is said to be what? Voluntary retirement receipt. And as you all know, the voluntary retirement receipt received by an employee also have that employer-employee relationship, and hence it have to be taxable under the head salary. Yes or no? But you can claim an exemption under section 10-10C in accordance with the limit provided under the respective section. Are you with me? Yes. How do you compute the exemption, friends? Exemption shall be lower of the following. Are you all listening? Yes. Are you all listening? Yes. Exemption shall be what? Lower of the following. Number 1, what is the first limit? Actual amount received. At the time of voluntary retirement, whatever your employer pays to you, that amount is limit number 1. What is limit number 2? Rupees 5 lakh. What is that? A statutory limit. What is limit number 3? Amount equivalent to 3 months salary for each completed year of service. Salary here means what? Basic salary plus DA forms part of the retirement benefit plus commission if it is a fixed percentage of turnover. That simply means what? Standard salary. So what is this third limit, friends? That is 3 into last drawn standard salary into completed year of service. This is limit number 3. Are you all with me? 3 months salary means what? 3 into last drawn standard salary into completed year of service. That will be limit number 3. Are you with me? Yes, and what is limit number 4? Salary at the time of retirement. That means last drawn standard salary multiplied by balance number of months of service left. What is that? What is this balance number of months of service left?
Till retirement.
See, you are anyways retiring before your age. So no, that is called as voluntary retirement. Are you with me? You are retiring before your retirement age. So there will be some balance number of service months left. Balance number of months of service left. Are you with me? So you last drawn salary into that balance number of months shall be limit number 4. 4 limits are there. What is limit number 1? Actual amount received. Limit number 2, 5 lakhs. Limit number 3, 3 into last drawn standard salary into completed year of service. What is limit number 4? Last drawn standard salary into balance number of months of service left. And pick the lower. And that lower shall be your exemption under section 1010C. If the actual amount is over and above the exemption, the excess shall be taxable as salary. It is as simple as that. Are you with me? Are you with me? Perfect. Now there is note number 2. What is note number 2? The exemption under this section would be available to the employee who have either completed 10 years of service or completed 40 years of age. For claiming this exemption, either your age should be 40 plus or you should have minimum 10 years of service. At the age of 33 or 30, you are voluntarily retiring. Then will you get any exemption? No. First of all, will you get any voluntary retirement compensation? That depends upon your employer. Whether he pays or not, you are not eligible for any exemption. Minimum you should have either 10 years experience or 40 plus years of age. Then only you are eligible for claiming this exemption under section 1010C. Are you with me? Are you with me? And note number 3, what is note number 3? Where exemption for voluntary retirement compensation under 1010C has been allowed in any year, then no exemption under this section shall be allowed to him in any other year. You can only claim this exemption once in your lifetime. Only once. Once you have claimed it, you cannot claim it again. Are you with me? It is not the statutory adjustment. They are saying only once. You have claimed it once, then no more exemption for you in your lifetime. Are you with me? Is that point clear? So friends, next component is perquisite. Let's understand what exactly is perquisite. So please listen. Perquisites means what? A benefit given by the employer to the employee. It can be monetary as well as non-monetary. I'll give you an example for perquisites. Say for example, you have studied house rent allowance, HRA. Yes or no? Under allowances. It was a monthly fixed amount given by the employer to the employee. Now, there is a perquisite for accommodation provided by the employer to the employee. Imagine a case where employer is giving the employee a place to live. The employer is giving his guest house to the employee and employee can stay over there for free without paying any amount to the employer. Isn't it a benefit received by the employee? Isn't it a benefit received by the employee? Yes, because he is not supposed to pay any rent. He can stay over there without incurring any additional expenses. So you need to value that benefit and you need to consider it as a component of the taxable salary. If the employer is providing benefit like this to the employee, you need to value the benefit and you need to consider that benefit as a component of what? Taxable salary. It is called as what? Perquisites. Are you with me? So perquisites can be monetary as well as non-monetary. How can it be a monetary perquisite? Say for example, the employer has taken a premises on rent and that premises is given to the employee directly. Who pays the rent? Employer. Who will enjoy the benefit? Employee. That benefit is on account of employer-employee relationship. Yes or no? So the rent paid by the employer have to be an income in the hands of employee. Why? Because he's getting a benefit due to employer-employee relationship. The concept is called as what? Perquisite. Now, what is the difference between allowance and perquisite? Allowance will be always fixed, but perquisite have a connection with the actuals. What do you mean by perquisite have a connection with the actuals? Either your rent will be paid by the employer or the employer will directly give you a premises to live in. Are you with me? But HRI is not like that. Every month I will give you a fixed amount. Whatever the actual amount is, we don't care. Every month we will give you a fixed amount. That is said to be what? Allowance. But perquisite will always have a nexus between the actuals that is incurred by the employee. Are you with me? Either the employer will provide it as a benefit or in monetary terms he will give. If in both the cases you need to value it and you need to consider it as a component of your taxable salary. Are you all with me? Have you understood the basics of perquisites? Yes or no? Alright. So listen friends, listen. As I've told you, perquisites, there are three types of perquisites. Let's understand what is what. Number one, perquisites taxable in the case of all employees. What do you mean by perquisites taxable in the case of all employees? The items that are coming under first category will be taxable in the hands of all employees. Are you all with me? Irrespective of your salary, irrespective of your designation, irrespective of the period of joining, etc., etc., it will be taxable in the hands of all employees, every employees. Are you with me? Moving on to the second one. What is the second category? Perquisites exempted from tax in the case of all employees. What is that? There are certain perquisites which are fully exempted in the hands of all the employees. That means the following, the items that are coming under category 2, the employees need not pay any penny as taxes. Fully exempted. Are you all listening? Moving on to the third category. What is the third category? Perquisites taxable only in the hands of specified employees. That means certain class of employees only category items are taxable. Specified employees simply means for the time being certain class of employees. We will learn what is specified employees when we move forward with perquisites. Are you with me? This perquisites is actually a lengthier topic. We have different types of perquisites. We will take each and every perquisite and we will consider it in different permutation and combination, so that in exam, whatever way they ask question, we will be able to solve the answer. Are you with me? Are you with me? Compared to your ICA study material, our charts are little bigger. Our charts are little bigger because we have considered all the permutation and combination. Because in exam, they may test perquisite according to their wish. So it is always study all the possible permutations and combinations. So we will discuss each and every perquisite in a detailed manner. So tell me how many types of perquisites are there? 3 types. Number 1, fully taxable in the hands of all the employees. Number 2, fully exempted in the hands of all the employees. Number 3, taxable only in the hands of specified employees. So basically 3 types of perquisites are there. So let's understand which all are the perquisites where we can enjoy exemption in the hands of all the employees. So we are about to discuss category 2 first. We are about to discuss what? Category 2 items first. Are you all with me? Are you all listening? Perfect. Now, under that, what is the first item? Can you read the first item? Amount of any contribution to an approved superannuation fund by an employer up to rupees 1,50,000, which is under section 17 subsection 2 clause 7. There is a detailed chart coming for this particular thing that we will discuss later. So this should be 7,50,000, okay, not 1,50,000. It is 7,50,000. That is amount of contribution to an approved fund by an employer up to 7,50,000 and subject to certain other conditions that we will learn in chart number 1 below. Are you all with me? These are just introduction of the exempted perquisites. We will have a detailed discussion over the exempted perquisites and the other perquisites in the upcoming sessions. These are the charts. So for the time being, I am just introducing one by one. After that, we will be having a detailed discussion on each and every other perquisite. Are you with me? Yes. So item number 1 is said to be what, friends? It is the amount contributed by the employer to an approved superannuation fund. Are you with me? Yes. Moving on to the second one. What is item number 2? Telephone provided by employer to the employee at his residence. Say for example, the employer has placed the phone or given a mobile phone to the employee and the employer is paying the bill. Who's paying the bill? Employer. And the employee is using that particular phone for his personal as well as official calls. Is he getting a benefit? Yes, for the personal call, employees not need to pay any amount because the employer will take care of the bill. Yes or no? But nothing shall be taxable. Nothing shall be what? Taxable. If the employer provide telephone at the residence of employee and he pays the bill as well, nothing shall be taxable because it is under the exempted category. Are you with me? Because majority of the calls will be only official call. That's why he have placed the phone at the residence of employee. That need is there. And hence department say nothing shall be taxable. There is no need for taxing any perquisite and nothing shall be taxable. Even if the employee uses that particular telephone for his personal purposes, leave it. Nothing shall be taxable. Are you all with me? Moving on to the next one. What is the next one? Can you read it loud? Transport facility provided by an employer engaged in the business of carrying of passenger or goods to his employees either free of charge or at concessional rate. That simply means if you are an employer and you are in the business of transportation and you are giving what? Free or concessional tickets to your employees, nothing shall be taxable in the hands of employees. Best example, say railway. Railway, say they give free tickets to the railway employees. Imagine a situation where the railway gives what? Free tickets to the employees. Actually, it's not free. They have to pay an amount. Imagine it is free. Is the employee getting any benefit? Is the employee getting any benefit? Yes. They don't need to pay any ticket for their personal journeys. So no. The department say nothing shall be taxable. So transport facility provided by an employer engaged in the business of carrying on passengers or goods to his employees either free of charge or concessional rate shall be fully exempted. Nothing shall be taxable. Are you with me? Moving on to point number 3. What is point number 3? Privilege passes and privilege ticket orders granted by Indian Railway to its employees. That is what I've told you. All the privilege passes and privilege tickets given by the railway to the employees again shall be fully exempted, specifically provided. Then, what is item number 5? Perquisites allowed outside India by government to citizen of India for rendering services outside India. Do you remember this? All the allowances and perquisites given by the Indian government to our embassy officers who are working outside India shall be fully exempted. That we have already discussed. Again, it is coming under perquisite as well. Why? Because this perquisite is also exempted. Are you with me? Item number 6, what is that? Employer's contribution to staff group insurance scheme. What is the staff group insurance? What do you mean by staff group insurance? Say you are my employees and I've taken a group insurance for all of your benefit. Are you with me? I've taken what? A group health insurance for all of your benefit. And I'm paying a lump sum premium. And I'm paying what? A lump sum premium. Each one of you is getting a benefit. What is that benefit? If something happens to your health, you can make use of that particular insurance. Are you with me? Are you with me? No worries, nothing shall be taxable. You don't have to pay the premium as well because I am taking care of the premium. You are getting a benefit. Why? Because you don't have to suffer any premium for the insurance. I am paying premium for the group staff insurance policy. Then nothing shall be taxable in the hands of my employees. Are you with me? Moving on to the next one. What is the next one? Payment of annual premium by employer on personal accident policy effected by him on the life of the employee. I've taken an accident insurance policy on you. What is accident insurance policy? If you meet up with some accidents, who will take care of the medical related payments? That insurance company will take care of the medical related payments. For that, normally you have to pay the premium because it is an insurance on you. But who pays the premium here? Employer. And you are actually getting a benefit. But nothing shall be taxable. Why? Because it is under the exempted category. Are you with me?
Yes, sir.
Are you with me? So what is that item number 7? Read it again. Payment of annual premium by employer on personal accident policy on the life of employee. Perfect. What is item number 8? Refreshment provided to all employees during working hours in office premises. Say for example, say in the morning break and during the lunch break and all, the employer gives you free tea, free vada, etc. I'm talking about udunu vada. Okay, free vada, free tea, free samosa, free burger, free pizza, etc. Are you getting a benefit? What is that benefit? You don't have to pay for the tea and vada. Yes or no? Don't worry. Nothing shall be taxable. Eat it peacefully. Okay. Don't worry about paying any income tax for having vada. Are you with me? So what they are saying is, item number 8, refreshment provided to all the employees during office hours in office premises. Working hours in office premises again shall be an exempted category. Now, what is item number 9? Subsidize the lunch or dinner provided to an employee provided the value of such meal is up to 50 rupees. What is that? Say I am giving you free lunch. At noon I am giving you what? Free lunch. Or we ourselves have a canteen. We have a canteen and the canteen charges one meal for rupees 50 and it is free for you. Are you getting a benefit? Yes, because you can have that meal for free. If the value of the meal is up to 50 rupees, nothing shall be taxable. What if the value of the meal is 70 rupees? 20 rupees shall be taxable. Are you with me? 3 meals up to rupees 50 shall be exempted. If the actual value of the meal is more than 50, the excess shall be taxable. First of all, let me ask you this question. Whether you will get a meal for rupees 50, right now I think it's very difficult to get a meal for rupees 50, but doesn't matter. You have to have it. Okay, maximum value of the meal up to rupees 50 only shall be exempted. Are you with me? So the point is very simple. Subsidized lunch or dinner provided to the employee. And what is the value of the meal? Up to 50. Don't say 250. Okay, up to. Then stop and say 50. Are you with me? Are you with me? Moving on to the next item. What is the next item? Recreational facilities, including club facilities, extended to the employee in general. That is not restricted to a few selected employees. What is recreational facility? Say in our office, there is a recreational area. Okay, you can play caroms, you can play chess, etc. in free time. But the employer will make sure that you have never seen that recreational area. Okay, he will keep on give you work. Say there is some recreational area where you can spend your time over there, like a slight gym and all, with treadmills. Certain IT companies are giving treadmills and inside gym setup. Okay, that employee is getting a benefit because they don't have to take a club membership or a gym membership separately. But nothing shall be taxable. The common recreational facility and basic gym facility, basic sports facility, etc. given by the employer to the employee shall not be a taxable perquisite in the hands of employee. Are you with me? Perfect. Moving on to the next one. What is the next one? Amount spent by employer on training of employees or amount paid for refresher management course including expenses on boarding and lodging. Say the employer is sending the employees for training. What is training? The basic training. Say for example, in the commerce field, the basic accountancy, they are providing a course on basic accountancy or corporate accounting. So for that, there is a cost incurred. And the employee is getting an academic addition, but nothing shall be taxable on employee because the predominant purpose is what? For the employer. Are you with me? And if there is any training expenses including boarding and lodging, you are staying in a place and attending the training, Nothing shall be taxable if it is fully sponsored by employer. You don't have to worry about the taxable value of perquisite. Are you with me? Read that point again. Amount spent by employer on what? On training of employees, or amount paid for refresher management course including expenses on boarding and lodging. Now, what is item number 12? Leave travel concession subjected to conditions under chart number 2. What is leave travel concession? Say the employer is sponsoring your personal tour. Employer is sponsoring what? Personal tour. Are you getting a benefit? Of course, yes. You don't have to spend a penny. Your employer will sponsor your tour. For that, you will get some exemption, but it is not a blind exemption. It is subject to certain conditions and regulations. That will be discussed in chart number 2. Chart number 2 is coming. This is said to be leave travel concession. Section 5 that we will discuss. Are you all with me? So if the employer is giving you some leave travel concession also, you can claim an exemption subject to certain rules and regulations. Then next one. What is the next one? Medical facilities subject to conditions given in chart 3 below. What is medical facility? The employer is providing free treatment to the employees, either in his own hospital or in some other hospital. In that case, you will get a benefit according to chart number 3. That is about to come. Chart number 3 is after leave travel concession. This is the one. Medical facilities. We will discuss each and every one separately. Are you with me? Yes. What is the next item? Item number 14. Rent-free official residence provided to judge of High Court or Supreme Court. If our judiciary is giving rent-free accommodation to the High Court or Supreme Court judges, nothing shall be taxable in their hands. It shall be fully exempted. But they are getting a benefit because the judges is not required to pay any rent. It is given as a free service. Yes or no? But nothing shall be taxable in the hands of judges. And what is point number 15? Rent-free furnished residence including maintenance provided to an office of parliament, union minister and leader of opposition in parliament. Rent-free furnished residence given to your members of parliament, union ministers and opposition leaders is again fully exempted. Our minister's house and all. The ministers will have an official residence. They don't have to pay any rent for that. But that is fully exempted in their hands only. Are you with me? Yes. And for opposition leader also, he will get it. So, that rent-free accommodation given to the member of parliaments and union ministers and leader of opposition again shall not be taxable in their hands. It is fully exempted. And the last one, what is that one? Conveyance facility provided to the High Court judges of under section 22B of the High Court Judges Conditions of Service Act 1954 and Supreme Court judges under section 23A of the Supreme Court Judges Conditions of Service Act 1958. That means, have you seen that High Court judge car? If you visit Chennai or you come to Kochi and all, you can see their white car. Okay, they will have that red board over there, High Court judge. That is the conveyance given by the judiciary to the judges, so that the judge need not spend any amount on the petrol or they need not call any taxi. He is getting a benefit, but nothing shall be taxed. It is fully exempted. Conveyance means the traveling facility. Are you with me? Free conveyance provided to the High Court and Supreme Court judges are also fully exempted. Are you all with me? Yes. So we have just introduced how many items? 16 items. It was just an introduction. Now we will be having a detailed discussion on each and every point one by one. Are you all with me? So moving on to the first item, that is treatment of approved superannuation fund. Let's understand what exactly is the concept of approved superannuation fund. So please listen. Employer's contribution. What do you mean by superannuation fund, first of all? What do you mean by superannuation fund? Superannuation fund simply means it is just like an amount which is created for the benefit of employee. Just like our provident fund, it is another fund, superannuation fund. If something happens to the employee or if he retires, the employer will give him a lump sum amount from that respective fund. Are you with me? Are you with me? Just like our provident fund, pension, gratuity, it is yet another fund which is for the benefit of employee, maintained by the employer as well as the employee. Again, a kind of savings. Are you with me? If something happens to the employee, kind of a death or incapacitation, the employer will give a lump sum amount to the employee. Or at the time of maturity also, the employer will give a lump sum amount to the employee. Now, to the superannuation fund as well, both the employer as well as the employee will contribute. And there will be interest on the employer contribution as well as on the employee contribution. And there will be withdrawal at the type of maturity from that superannuation fund as well. Do you remember our provident fund concept? Are you all with me? Do you remember the concept of provident fund? Towards provident fund, both the employer as well as employee contributes. And there will be interest on the employer contribution as well as employee contribution. And we have understood what is the treatment of income tax at the time of deposit as well as at the time of withdrawal. Similarly, to superannuation fund also, both the employer will contribute, employee will contribute, and there will be interest component on both their contributions. And we should know the income tax implications at the time of deposit as well as at the time of withdrawal. Are you all listening? First, let's understand what is the income tax implication of employer's contribution. So, can you read the first box under that? Employer contribution is exempt from tax in the hands of employee, but only up to 7,50,000 per employee per annum. Employer can contribute an amount for the benefit of employee to a superannuation fund, no problem. But how much is the maximum exemption? 7,50,000. The maximum amount of exemption that the employee can take is 7,50,000. Imagine a case where an employer contributes 8 lakh to approved superannuation fund in a year. Then what will happen? Over and above 7,50,000. That is, that extra 50,000 shall be taxable in the hands of employee as perquisite. Are you all with me? If any employer contributes more than 7,50,000 to superannuation fund, to an approved superannuation fund for the benefit of employee, up to 7,50,000, nothing shall be taxable, or the contribution over and above 7,50,000 shall be taxable as a perquisite. In whose hands? In whose hands? Employee's hands. Are you with me? Are you with me? Perfect. Moving on. How about the employee's contribution? Read. Employee's contribution qualifies for deduction under section 80C, similar to the PF. Employee contribution to recognized provident fund allowed as the deduction under 80C. Do you remember? Similarly, here also, if the employee contributes some amount to an approved superannuation fund, that amount contributed is allowed as a deduction under 80C. That is chapter 6A deduction. From the gross total income, you have to claim it. Are you with me? Moving on to the interest component. Can you read that point? Interest on accumulated balance is exempted subjected to limits and conditions. There are certain limits and conditions, and that we will learn right now itself. Are you with me? Very simple. Employer contribution to superannuation fund. You tell me what is the treatment? Up to 7,50,000, nothing shall be taxable. If the contribution is more than 7,50,000, excess shall be taxable. In the hands of employee as perquisite. Employee contribution is allowed as deduction under 80C. Interest on employer contribution and employee contribution is exempted but subject to certain conditions and limits. That's what we are about to learn here. Okay, the conditions and the equation that we will learn later. Are you with me? Yes. Have you understood the concept till now? Now we are directly jumping to what? The payment receipt by an employee from superannuation fund, or we can call it as withdrawal from superannuation fund. Are you with me? Say there is some withdrawal in respect to a superannuation fund, and let's understand what is the income tax implication if there is a withdrawal from superannuation fund. Are you all with me? Are you all with me? So at the time of withdrawal, let's see. So read it along with me. Any payment received by any employee from superannuation fund shall be exempted under section 10 subsection 13 provided such payment is due to death of beneficiary. What is that? Due to the death of employee, they are withdrawing an amount. Nothing shall be taxable. Are you with me? Because it shall be fully exempted. Which is the section 10, 13. 10 subsection 13. 10 subsection 11 was SPF, PPF withdrawal. 10 subsection 12 was RPF withdrawal. 10 subsection 13 is approved superannuation fund withdrawal. Are you with me? 11, 12, 13. Are you all with me? So, if it is due to death of beneficiary, who is the beneficiary? The employee. Employee is the beneficiary. Due to the death of employee, you are withdrawing an amount, nothing shall be taxed. Then, next one. His retirement or a retirement act or after a specified age or on his becoming incapacitated prior to the retirement. That means on his retirement, he have withdrawn. Or after a specified age, that means at the age of 50 or 55, whatever it is, or becoming incapacitated. What is incapacitated? He came up with some kind of an accident, or he lost his leg, or he is no longer able to work properly. There is some kind of disability happened, or incapacitation happened. He lost his memory, something like that. Are you with me? If something like that happens also, you are withdrawing an amount, nothing shall be taxable. Then, by way of refund of contribution on the death of beneficiary. What do you mean by way of refund? If the initial phase itself, there is a debt for the employee and the entire amount is refunded back to the employee, nothing shall be taxable. It is not a maturity. If it is refund, that means there will be some minimum period. Once you are into an employment, there will be a minimum lock-in period. What is minimum lock-in period? You have to manually deposit that fund to a certain 2 years or 3 years. If within that period itself, you have met up with an accident or you have already dead within that time itself, and you will get the entire amount as refund. If it is a kind of a refund also, nothing shall be taxed. And what is the last one? By way of transfer to the account of employee under pension scheme. Similar point we have already discussed. You are transferring superannuation fund to your national pension scheme, NPS, referred under 80cc D. Do you remember this? RPF also we have seen a similar condition. So in the four circumstances, if there is a withdrawal, nothing shall be taxable. Otherwise, the entire withdrawal shall be fully taxable. Are you with me? Let's discuss that point again. Which all are the first point? What is the first point? On death of beneficiary, employee. Number two, retirement at or after specified age or becoming incapacitated. Then point number 3, by way of refund of contribution on the death of beneficiary. And the next one, by way of transfer to the account of the employee under a pension scheme under 80CCD, which is notified by the central government. In these four circumstances, nothing shall be taxable. You can claim an exemption. In other cases, there will be taxability. Are you with me? Are you with me? So that was the first point, friends. Listen. Moving on to the next one. Employer contribution exceeding certain limits. So this is little bit tricky. I want all of you to be super attentive right now. Otherwise, definitely you will go mad. This is one of the most complicated topics in salary. And I want all of you to be super attentive right now. Are you with me? Otherwise, you have to mug up this. Don't think that you will be able to by heart it. It is actually very, very tough to by heart. But I'll make sure that you don't even have to remember this formula. We will derive this formula. Are you with me? But the only one thing that I want from your side is your attention. So, listen. What is the heading? Employer contribution exceeding certain limits. Again, it's a taxable element of perquisite. That's what we are about to discuss. So, can you read the first box? Contributions made by employer exceeding 7,50,000 for the benefit of employee shall be taxable perquisite if it is towards recognized provident fund, national pension scheme under 80CCD or approved superannuation fund. That simply means, listen, if any employer contributes any sum for the benefit of employee, either to a recognized provident fund or to a national pension scheme or to a approved superannuation fund, and the amount of contribution in a year exceeds 7,50,000, all the excess contribution shall be taxable perquisite. Are you with me? Just now only we have discussed it. If the employer is contributing that excess amount over and above 7,50,000 to approved superannuation fund, excess shall be taxable. That means up to 7,50,000 you can claim exemption. Are you with me? But there is one more thing. What is that? Listen, there are three types of funds. Which are the three types of fund? Repeat with me. Number one, recognized provident fund. Number two, national pension scheme. Number three, approved superannuation fund. Listen, say for example, there is a company and he is the employer and there is an employee. This company every year contributes 10 lakh rupees. This company contributes how much? 10 lakh rupees to the employees. Are you with me? To one employee towards recognized provident fund. Towards what, friends? Recognized provident fund. Then what will happen? If they contribute something to recognized provident fund or national pension scheme or approved superannuation fund, ASF means approved superannuation fund, then what will happen? You tell me. Out of this, how much is taxable? 2,50,000 shall be taxable. Perquisite in whose hands? In employee's hands. Are you with me? Are you with me? What if the company is giving 3 lakhs to RPF, 3 lakhs to NPS, and 4 lakhs to ASF? Then also 2,50,000 shall be taxable perquisite. That 7,50,000 is a combined limit. Not for RPS alone, or not for NPS alone, or not for RPF alone, or not for ASF alone. Combined limit is 7,50,000. Are you all with me? That means in the example that I've told you, if you are contributing more than 7,50,000 altogether to any of these accounts in a year, then excess contribution shall be a taxable perquisite in the hands of employees. Are you with me? Let's go back to that box again and read the theory. So I want all of you to read that theory along with me. Read it again. Contributions made by employer exceeding 7,50,000 for the benefit of employee shall be taxable perquisite. Perquisite if it towards recognized provident fund, national pension scheme, or approved superannuation fund. You are contributing all together in a year in excess of 7,50,000 rupees. Excess contribution shall be your taxable perquisite under perquisite valuation. Are you with me? Are you with me? Not yet over. This provision came to Income Tax Act with effect from 1st April 2020. This came to Income Tax Act with effect from 1st April 2020 only. That's why there is a date over there. Are you all with me? Now, not yet over. This is very easy because you have to simply manually compute the employer contribution to a respective year, whether it exceeds 7,50,000 or not. Are you with me? Next thing is the tough element in this. And can you read the next paragraph? Annual accretion, that is interest to the balance. Hello, I told you to read, okay? I want all of you to read it together. Annual accretion, that is the interest to the balance at the credit of recognized provident fund, national pension scheme, or superannuation fund, which relates to the employer's contribution and included in total income on account of same, having exceeded 7,50,000 also shall be taxable perquisite. What do you mean by that? Listen, what they are saying is, say, we will simplify this example, okay? For the simplicity, I will take it like this. Say the employer is contributing something to, say, NPS, something to NPS, 10 lakh rupees to NPS in 2023-24. Are you all listening? The employer is contributing how much? 10 lakh rupees to National Pension Scheme in the year 2023-24 for the benefit of employee. Number one, what is the first problem? The first problem is over and above the contribution given by the employer for the benefit of employee towards NPS, RPF or ASF, which exceeds 7,50,000 shall become taxable perquisite in the hands of employee. So you tell me out of this how much is the taxable perquisite? How much is the taxable perquisite? Taxable perquisite shall be 2,50,000 in the hands of employees. Yes or no? Not yet over. Interest on this 2,50,000 is also a taxable perquisite because every year you will get interest on that entire 10 lakh. If you are getting interest on that excess contribution, that interest also will be your what? Taxable perquisite. Are you with me? So two things have to be considered as taxable perquisite. Number one, excess contribution. Plus interest on excess contribution is also will be your taxable perquisite. Are you with me? Are you with me? Interest on excess contribution plus excess contribution both will become your taxable perquisite. Are you all here? But for computing the excess contribution, it is very easy. You can mechanically compute it. Computing the interest component is actually a little bit tough because there can be accumulation, that means compounding effect may come in between. For that, what department say is, department comes up with a formula and what they are saying is computation of such annual accretion for a previous year have to be done based on this equation. You have to compute the taxable interest perquisite by making use of this equation. Are you with me? Are you with me? We will derive the equation. Okay, first of all, let's understand what is that equation. Then I will tell you what is the logic of that equation. So, what do they say? The taxable interest perquisite shall be computed by making use of this particular equation. So, can you read the equation? What is the equation? Read it. PC by 2 into R plus PC1 plus TP1 into R. Read it again. PC by 2 into R plus PC1 plus TP1 into R. Are you all with me? Let's understand what is this PC, what is R, what is PC1, what is TP1, etc. etc. Are you all with me? So let's divide this formula into two parts. We are dividing this formula into two parts. Part number one, this area. Part number one, this area, and there is one more part, that is part number two, that is the other one. Okay. So this is part number 2 and the other one is part number 1. So we are focusing only on part number 1 right now. Forget about part number 2. Are you all listening? Forget about what? Part number 2. Only think about part number 1 for the time being. Once we complete part number 1, we will think about what? Part number 2. Are you with me? So listen. Listen. So what they are saying is very simple. Listen. Say, so the company is giving employee, say 12 lakh in a year. 12 lakh in a year. Are you with me? As you all know, the contribution exceeding 7,50,000 shall be taxable in the hands of employee. So can you tell me how much is exceeding 7,50,000? Exceeding 7,50,000 is what? 4,50,000. So that 4,50,000 will be a taxable perquisite in the hands of employee. and interest on 4,50,000 is also a taxable perquisite. But how do you compute that interest? That's what we are about to discuss right now. Are you with me? For that, what is the first part of the formula? PC by 2 into R. Forget about the second part. The first part of the formula is how much? PC by 2 into R. Let's understand what is this PC by 2 into R. What is PC? Can you read what is PC? Aggregate of the amount of employer contribution in excess of 7.5 lakh towards RPF, superannuation fund or NPS. Are you with me? Read that again. Aggregate of. That simply means, according to the example, you tell me how much is PC. How much is PC? According to this example, how much is PC? PC is equal to 4,50,000. So PC simply means the excess contribution above 7,50,000 towards RPF, that means recognized provident fund or national pension scheme or approved superannuation fund. So according to the example, PC is how much? PC is how much? 4,50,000 divided by 2. Why there is a 2? I'll tell you later. Divided by 2 does not have any other intention right now. For the time being, you simply understand it as a standard formula. Are you with me? But I'll tell you the logic of divided by 2 also. Okay. So divided by 2 into R. What might be R? What might be R? Rate of interest. Yes or no? R will be what? Rate of interest. But rather than that, what they are saying is, what is R? There is a definition for R. What is R? Income by fund average. What is income? What is income? Not salary. Income in respect to that fund means that total accretion, interest. Are you with me? Divided by fund average. So let's understand what exactly is this. What is income rate? Aggregate of amounts of income accrued during the previous year in recognized provident fund, NPS or superannuation fund. That means current year interest is said to be what? Income. We are discussing in respect to that fund, not about the taxable perquisite or taxable salary. First, we need to understand how much is the interest element. Are you with me? And what is income? Tell me. The current year interest. It is as simple as that. The current year interest divided by fund average. What is fund average? Read. Opening balance of that respective fund plus closing balance of that respective fund during the current year divided by 2. Opening plus closing divided by 2 is said to be the fund average. Income divided by fund average will give you what? Income, current year interest income divided by fund average will give you what? R means what? Rate of interest. Are you with me? What the department say? You go to that respective fund and find out how much is the current year income. You divide it by the fund average, you will get the rate of interest. Are you with me? That rate of interest on that excess contribution will be the taxable perquisite. Are you with me? But there is a problem. What is this by 2? Let's see what is this by 2. That is average. I'll tell you what is this by 2. Imagine. Say, how do this contribution actually happen? Every month along with the salary, the employer will contribute something for the benefit of employee. Hope you remember the RPF. It is a monthly contribution. Are you with me? Are you with me? Now you tell me, in the month of April, how much will be the employer contribution? According to the example that I've written, in the month of April, how much will be the employer contribution? 1 lakh. May, another 1 lakh. June, another 1 lakh. July, another 1 lakh. So, it get accumulated and only in the 8th year, that will exceed 7,50,000. Not 8th year, sorry, 8th month. Only on the 8th month, it will exceed 7,50,000. Are you with me? Yes. So you cannot charge that rate of interest directly on this 4,50,000 because that 4,50,000 is not there throughout the year. The excess is not there throughout the year. The excess is coming only on 8th month. Yes, sir. Yes, sir. Yes, so every month employer is contributing 1 lakh each to that respective fund. And that 1 lakh will become 2 lakh in second month. It will become 3 lakh in third month, 4 in fourth month, 5, 6, 7, and when it touches 8 only, it is exceeding 7 lakh 50,000. So 8th month only, it is going above 7 lakh 50. Are you with me? So if you directly charge the rate of interest on 4 lakh 50, it will be a hardship for the employee because that 4 lakh 50 is not there throughout the year. It is coming only on that exceeds only on the 8th month, 9th month, 10th month, 11th month, 12th month. Are you with me? So what department say, instead of avoiding this computation or confusion, do one thing, you take the average. You tell me, in April, how much is the excess contribution? 0. There is no excess contribution on April because opening will be always 0. In the year end, how much is the excess contribution? In the year end, according to the example, how much is the excess contribution? 4 lakh 50,000. You average it, divided by 2. Opening plus closing divided by 2. Rather than this, they are saying 4 lakh 50,000 divided by 2. That is called as PC by 2. Because opening of the excess contribution will be always 0. The closing will be 4 lakh 50,000. So opening 0 plus that PC divided by 2. Rather than saying that, they have simply said PC by 2. Are you with me? Yes. Are you with me? Yes. Are you all listening? Yes. So opening plus closing by 2. Instead of that, 0 plus excess divided by 2. Instead of that, excess by 2. That is PC by 2 into rate of interest will give you the current year excess contribution or current year interest on excess contribution. Are you with me? Are you with me? All right. So this is year 1. That is in 23-24. This is in the year 2023-24. Now is the crucial thing. Now is the crucial thing. I want all of you to be super attentive. Otherwise, you have to by heart this formula. Okay. Now, and you go refer institute study material also. They will, after reading the institute study material, you will never get an idea because it is that complicated. We are trying to make it as simple as possible. Are you with me? But if you are not attending it, I cannot do anything. You have to make sure that you are listening. So that I want all of you to note down important facts and figures. Take down lecturing notes. That will be always better for better attention. Are you with me? Yes. Are you with me? Yes. Moving on to the year 2. Say in 2024-25. Forget about 23-24 now. Forget about 23-24 because we have computed both the excess contribution 4 lakh 50 and rate of interest on excess contribution as well. Are you with me? Yes. In the next year, say next year, again that company is contributing 24 lakhs. The company employer is contributing how much? 24 lakhs to NPS for the benefit of employee. That means 2 lakh each every month. Are you with me? Now, when it comes to year 2, we will stick on to the formula. What was the first part of the formula? PC by 2 into R. You tell me what is the PC in year 2? What is the PC in year 2? Year 2's excess contribution. So no, year 2's total contribution is 24 lakh. How much is over and above 7 lakh 50? 16 lakh 50,000 is PC. Divided by 2 into rate of interest. That is second year's income divided by fund average. Are you with me? But there is a problem. In second year, there is excess contribution of first year because we are not withdrawing them all. In second year opening balance, there will be that excess contribution of first year and you will get interest on the entire opening balance of second year. Yes or no? You will get interest on the entire opening balance of second year. That includes excess contribution of first year also. Are you with me? Yes. How it works? Imagine in the second year beginning, the employer will keep on contributing to that respective fund. Year 1's contribution is already there in the fund balance. For that also you will get what? Interest, because interest is charged on the fund balance. That includes balance of year 1 as well. So you tell me, Year 1, how much was the excess contribution? Year 1, 4,50,000 was the excess contribution in year 1. On that also, year 2, you will get what? Interest. On that excess contribution also, you will get interest in year 2. That is also your taxable perquisite in year 2. Are you with me? Yes. Not yet over. In year 1, you will get interest on excess contribution. That interest is there in the closing balance of year 1. On that interest also, you will get interest in year 2. That is called as interest on interest. Compounding. Are you with me? Say, listen, in year 1, your excess contribution was how much? 4,50,000. Year 1, you will get, say, rate of interest is 10%. Year 1, say, rate of interest is what? 10%. We said that 4,50,000 divided by 2 into 10% was the year 1's taxable perquisite. Yes or no? How much will be the taxable perquisite for year 1? We are talking about year 1 right now. 4,50,000 divided by 2 into 10%. 25,000. Come again. 22,500. So 22,500 will be the taxable perquisite. In relation to that is the interest on the excess contribution of year 1. Now my question is, where is this interest right now? Is it with the employee or is it with the fund? It is with the fund only because the employee haven't withdrawn that amount. It is there in the fund only. Are you with me?
Yes, sir.
So in the year 1 end, we can say that the fund balance will be total 12 lakhs plus entire interest. Yes or no? Yes or no? Fund balance plus entire interest. What is entire interest? Interest on that entire 12 lakh rupees. Are you with me? Which includes this 22,500 as well. Are you with me? It is exempted, but it is there in the fund, right? You are not thinking. It is there. See, imagine it as a bank account. Okay, the bank will give interest based on your exemption, or bank will simply give your interest. They will simply give you interest, whether it is exempted or taxable. Every year the bank will give you interest. Likewise, in the fund, you will have year 1's contribution plus interest of year 1. Are you with me? So, when it comes to year 2, this is there in the closing balance of year 1. That excess contribution plus interest on the excess contribution is there in the closing balance of year 1. Are you with me?
Yes.
Are you with me?
Yes.
In year 2, according to the example, it was 24 lakhs. I've told you that the employer have given what? 24 lakhs to the employee. Are you with me? So in year 2, you tell me how much is the excess contribution? 16,50,000 was the excess contribution divided by 2. Say year 2's rate of interest is 12%. Year 2's rate of interest is how much? 12%. You will get 12% on year 1's excess contribution as well in year 2. Why? Because year 1's excess contribution is there with the fund balance. Are you with me? Year 1's excess contribution was how much? 4,50,000. There you don't need to divide it by 2. Why? Because from the year 2 beginning itself, that excess contribution is over there. Are you with me? If you are still not getting an idea on this equation, by heart it. That will be better. Are you all with me? This is the maximum extent that I can explain because it is the power of compounding. You should know what is compounding for this. Are you all with me? In year 2, you will get interest on that excess contribution plus, not your year 1's interest is there on excess contribution. That interest is also there in year 2's opening balance. Yes or no? On this interest also, you will get interest in year 2. So, year 1's excess contribution plus year 1's interest on excess contribution, all together, you will get interest on year 2. That is also your taxable perquisite. When it goes to year 3, year 3's excess contribution divided by 2 into R plus year 1 and 2's excess contribution plus year 1 and 2's excess interest will be there. On that entire figure, you will get what? Interest. This is what is compounding. Nobody is withdrawing any amount. They are keep on accumulating. Are you with me?
Yes, sir.
To cope up with this, they are coming up with this second part of the formula. What is the second part of the formula? Can you read the second part of the formula? PC1 plus TP1 into R. You tell me what is PC1. Can you read what is PC1? Aggregate of amount of employer's contribution in excess of 7,50,000 to RPF, superannuation fund or NPS for the previous year or years commencing after 1st April 2020 other than current year. In PC1, you shouldn't consider current year excess contribution because this is for the last years starting from 1st April 2020 because that is the effective date of insertion of this point in income tax. Are you with me? And what is TP1? Aggregate of the taxable perquisite under section 17 subsection 2 clause number 7a for the previous year or years commencing on or after 1st April 2020 other than the current previous year. That is aggregate of the taxable perquisite. What is aggregate of the taxable perquisite? That is last year's taxed interest. On that interest also you will get what? Interest in year 2. Are you with me?
Yes.
Listen, I will repeat that example once more. For all those who haven't understood it, please listen. If you're not listening it, you will not get it. Those who have understood, you will understand it in a better way. You also listen. Okay. So, we will stick on to the original example. Okay. Based on certain facts and figures only, we will be explaining this concept. Listen. Say, year 1. Employer contributed how much? How much? According to our example, 12 lakhs to say NPS for the benefit of employee. Are you all here? So, as you all know, excess contribution over and above 12 lakh, over and above 7,50,000 shall be a taxable purpose. For that, we don't require any equation. Interest on excess contribution also shall be a taxable purpose. Are you with me? How do you compute that interest? Very simple. You take that excess contribution of 4,50,000. How it become 4,50,000? 12 is the total contribution. 7,50,000 is the limit. So excess will be 4,50,000. So 4,50,000 divided by 2 into rate of interest. Imagine rate of interest in year 1 as 10%. We are assuming that the rate of interest in year 1 is how much? 10%. So 4,50,000 divided by 2 into 10%. Are you with me?
Yes.
In year 1, that PC1 plus TP1 into R will be always 0. Why? In year 1, there is no compounding because you have just started investing it. Are you with me? That is why in the original example, I haven't mentioned anything about the second part of the formula. Because in year 1, always there won't be any opening balance. Because that is why it is called as year 1. Are you with me? Year 1, in the year 1 opening balance, there won't be any excess contribution. So that PC1 plus TP1 into R will be always 0, nil in year 1. Are you all here? Alright. Now, moving on to year 2. Year 2. In year 2 opening balance, you tell me what are the components of opening balance of year 2? You tell me. Tell me what all are the components of opening balance of year 2. Tell me what all will come. First of all, we'll start from basics. Number 1, employer contribution up to 7,50,000. Yes or no? Employer contribution in year 1 up to 7,50,000. Then number 2, employer contribution in year 1 above 7,50,000. Yes or no? How much is that employer contribution in year 1 which is over and above 7,50,000? How much is that figure? 4,50,000. It is 4,50,000. Then, what is the next component? Employee contribution will be there. Because to that respective fund, both the employer and employee contributes. Employee contribution will be there. We don't have to bifurcate into over and above 50 or less than 50 because that doesn't make any difference. Employee can contribute as much as he wants. There is no perquisite element because it is going from his pocket only. So, employee contribution there. Then, one more thing will be there, that is interest on employer contribution up to 7,50,000 and interest on excess contribution over and above 7,50,000. So, listen, there will be interest on, keep quiet and listen, there will be interest on that 7,50,000 and there will be interest on excess contribution over and above 7,50,000 and there will be interest on the employee contribution as well. And what is the year one's interest? 10%. Are you with me? These are the components of opening balances. Are you with me? Now, think in year 2, you will get interest on year 2's 7,50,000 contribution, year 2's excess contribution, year 2's employee contribution, and year 1's employer up to 7,50,000 contribution, year 1's employer excess of 7,50,000 contribution, year 1's entire interest also you will get interest in year 2 because everything is there in the fund itself. Are you with me? Yes. Say in year 2, the contribution is 24 lakh as we have discussed. The contribution is 2 lakh each, 24 lakhs. You tell me what is the formula? PC by 2 into R plus PC1 plus TP1 into R. This is the formula. Now, what is PC by 2? Now it is year 2. What is PC by 2 in year 2? Your actual contribution is 24 lakh. How much is over and above 7,50,000? 16 lakh 50,000 is the excess contribution divided by 2 into rate in year 2 is 12%. Rate in year 2, imagine it is how much? 12%. So into 12% plus PC1. What is PC1? Year 1's excess contribution is said to be PC1. You tell me from the formula. 4,50,000 is PC1 plus what is TP1? Year 1's interest on excess contribution is said to be what? TP1. TP1. Taxable perquisite of year 1. Are you with me? Yes, sir. That is not like that, but for you, you understand it like that. TP1 is what? Taxable perquisite of year 1. How much is taxable perquisite on year 1? It was 22,500. We will write taxable perquisite of year 1 itself. Taxable perk of year 1 into year 2's rate of interest 12%. When it comes to year 3, how do you compute taxable perquisite in year 3? Year 3's excess contribution divided by 2 into year 3's rate of interest plus year 1 and 2's excess contribution plus year 1 and 2's interest on excess contribution into rate of year 3. When it goes to year 4, 1, 2, 3 you have to consider. Year 5, 1, 2, 3, 4 you have to consider. That is called as compounding. Because nobody is withdrawing the fund, everything is getting accumulated with that fund itself. Are you with me? Yes. Are you with me? So friends, you tell me, how do you compute the interest element, that is the interest on excess contribution? What is the formula? PC by 2 into R plus PC1 plus TP1 into R. Out of that, what is PC? Aggregate of amount of employer's contribution in excess of 7,50,000 towards RPF, superannuation fund or NPS. What is R? Income divided by fund average is R. Now, what is income? Aggregate of amount of income accrued during the current previous year in recognized provident fund or RPF, that is recognized provident fund, or NPS or superannuation fund. What is fund average? Opening balance of that respective fund during the current year plus closing balance of that respective fund during the current year divided by 2. What is PC1? Aggregate of amount of employers' contribution in excess of 7.5 lakh to RPF, superannuation fund, NPS for the previous year or years commencing on or after 1st April 2020 other than current year. Because in PC1 is intended for the past years. That too only maximum from 1st April 2020. Why? Because only on 1st April 2020 we inserted this taxable perquisite clause in Income Tax Act. Are you with me? Yes. Then what is TP1? Aggregate of the taxable perquisite under section 17 subsection 2 clause 7a. That is a taxable perquisite on interest on excess contribution. That for the previous year or years commencing on or after 1st April 2020 other than current previous year. Are you with me? Yes, because current previous year is the first part of the formula. Second part of the formula, past year's perquisite element. On that also you will get interest. Are you with me? So this is how you have to use that formula. Again, repeat the formula. What is the formula? PC by 2 into R plus PC1 plus TP1 into R. PC current year by 2 is the averaging. R is the rate, that is income by fund average. Plus PC1 is the past excess contributions. Plus TP1 is the past taxable interest perquisites. Into R is the current year interest again. Are you with me? Yes. Are you with me? Have you understood the formula?
Hello my dear ones, this is CA Jose Kurian and this video is to inform you about how to purchase our book as well as recorded lectures. For the book, you visit www.cajosecurian.com. Then you scroll down and you can see our both handbook as well as workbook for CA as well as CMA, Inter as well as Final. For the lectures, you scroll up, then click onto the classroom. In the classroom, you can scroll down and you can see all courses listed. We have CMA Final English as well as Malayalam, then CA Final English as well as Malayalam, then we have CA Inter English as well as Malayalam. Then select your course, make the payment and you will get instant access. Alright, now what are you waiting for, friends? Subscribe now. All the very best, take care and God bless you all.